Everyone, a minute to go until the start of cash equity trading. I'm Francine Lacqua in London with Tom McKenzie.
And here are your top stories. Staking out positions, Fed hawk Christopher Wallace says he favours a quarter-point hike at the next meeting, while Class Knott sees at least 2 more 50 basis point increases for the ECB. Fading recession odds, JP Morgan sees chances of an economic downturn falling across markets. The dollar drops, with European futures marginally higher. Plus, closing ranks. Olaf Scholz and Emmanuel Macron warn European businesses will need to dramatically boost spending to keep pace with the US and China.
So, Tom, let's take a look at the futures for everyone, of course, watching in Asia and China especially. First of all, happy Lunar New Year. It does mean that major centers in Asia are closed for the celebration, so we're probably seeing less volume across the board. But for the moment, DAX futures and FTSE futures getting between 0.2 and 0.4%.
Yeah, some really interesting lines coming out from the investment banks then on the recession risks. As we had said in the headlines, JP Morgan, with its model across 9 different assets, 7 different asset classes, pointing to a lower than 50% chance of recession. The FTSE 100 currently pointing to gains, very modest gains of about 0.1%. Morgan Stanley's Mike Wilson, by the way, coming out saying that the overwhelmingly weak macroeconomic data has not yet been priced into these markets. The FTSE 100 currently up 5 points, 9 points in fact. The Spanish IBEX gaining about 0.1%, and over in France gains of 0.3%. More industrial action here in the UK, and of course investors weighing up the commentary then from ECB officials. Class Knott, of course, coming out saying he wants to see at least 2 50 basis point hikes going forward. And then, of course, on the flip side, arguably, the Fed officials towards the end of the week softening their tone, pointing to 25 basis points at the next meeting. And that gave a very strong rally, particularly to the NASDAQ towards the end of play on Friday. The S&P ended up around 1.9%. Let's switch it over and see how things are playing out across these sectors then. A major week, by the way, for technology. And again, NASDAQ ending up on Friday close to 3% in terms of the gains. We'll see if that can really be sustained given the challenges across the tech sector. The futures just range bound now for US futures. Of course, much of Asia is closed then for the Lunar New Year holidays. Euro dollar strengthening, currently at 109 for the euro, a gain of a little over 0.5%. 109, the 10-year over in Italy, just up 2 basis points. Again, weighing up the commentary, the more hawkish commentary from ECB officials at just over 4 on the benchmark over in Italy. And Bitcoin gaining, again, pointing to the modest risk-on sentiment that you starting to see. Gains of 0.4%, just above 22,000 now for crypto. Francine.
Tom, if you look at the industry groups moving the most, so first of all, we do have some losses, but they're not huge losses. Chemicals, healthcare, utilities down about 0.2%. On the upside, I am looking at technology, auto parts, real estate, and banks gaining some 0.8%. And then, of course, we look at some individual stocks. One of the biggest losers in today's trading session, for example, is a famous Italian football club, Juventus, and this is because they got 15 points taken off their Grand Slam because of how they account to transfers, and I think the share price is down some 15%. So we'll look at that a little bit more in depth. Let's also get to our markets reporter, Valerie Teitel, who's looking ahead to U.S. tech earnings out this week.
Yes, Francine, that's right. I want to note that our Bloomberg Intelligence is noting that over a 9% drop in profits from the third quarter. This is going to be the biggest drag on profits in the S&P for this fourth quarter, and it's expected to shrink the most since 2016. It's notable that that's when the Fed was guiding its previous tightening cycle. But look, Wall Street has been slashing earning estimates for months in the tech sector. The profit outlook has deteriorated rapidly, but the main question, Francine, is has it deteriorated enough? Funny enough, the data compiled by Bloomberg Intelligence points that the specific tech sector in the S&P 500 will return to growth in the second half of this year. So the danger is this going to prove too optimistic? Are these analyst estimates too optimistic? As we know that the Fed is looking to hold rates at 5%. But in my estimation, they're maybe just taking a page from the rates book. We see over 100 basis points of cuts are now priced for the Fed out until March next year. And perhaps we're just a bit too optimistic that the Fed can manage this soft landing. A clear direction for the U.S. economy is still yet to come clear. We're sitting now in 2013, but a Fed pivot and a cut to neutral is what the market is now expecting.
In terms of cuts by March of 2024. Really fascinating. Valerie Teitel, thank you for the breakdown. Let's delve deeper into these markets then. The dollar weakening against most of its G10 counterparts, while Japanese stocks with many major centers in Asia closed, of course, for the Lunar New Year celebrations. Let's bring in BlackRock Global Chief Investment Strategist Wei Li. Wei, good morning. Thanks for joining us this Monday. Just give us the update on the team at BlackRock in terms of these recession risks. We're hearing two different narratives this morning from the likes of JP Morgan and Morgan Stanley. JP Morgan saying that they're looking across in terms of their model across asset classes. 7 out of 9 now suggesting that there is a less than 50% chance of a recession in the US. But Mike Wilson over at Morgan Stanley is saying, look, the macroeconomic data is overwhelmingly weak. It isn't yet priced in.
I think the way to reconcile the two narratives is that markets are certainly pricing out a recession, right? If you look at market indicators, recessions don't seem to be on the cards. But the way that we see 2023 playing out is that a recession is foretold because we're not out of the woods with inflation, especially core service inflation is still pretty persistent. So we believe that central banks, including the Fed, will have to power through and push on in terms of rate hikes and stay elevated close to peak rates for longer than what markets are currently appreciating. And that will lead to a recession.
This is what the markets just don't want to believe, right, that we'll have interest rates at, 4 or 5% for much longer than expected. What will convince them?
I think as it becomes clear that actually inflation is more persistent than what markets are currently extrapolating from the last 3 consecutive data points. What we're seeing is that, of course, goods service rotation is leading to headline inflation falling quite quickly, and that is our expectation as well. But the service component, the wage component, even including the shelter component, may well prove to be persistent, and ultimately 3 is perhaps the new 2. So yes, inflation will fall very quickly, but it's going to settle at a higher level than what markets are appreciating, and that will stop the Fed from actually being able to cut aggressively as what markets seem to be pricing.
Is that move from 4% on inflation down to 2% that's going to be so challenging is the view from you and the team at BlackRock. So what does that tell us about the bond market rally that we've seen? I'm looking at the US 10-year, currently 348. So it's essentially flat in the session today, but 348, there's been a big move into the bond markets. Has it been overdone given that view on the stickiness of inflation and the need to hold rates for higher?
We would definitely want to kind of short the long end of the government bond market, precisely because we believe that term premium needs to come back in, and also because of what you just described in terms of markets applying an old recession playbook, expecting central banks to come to the rescue of the economy, not really differentiating the fact that this recession is caused by central bank over-tightening versus previous recession. Yeah. But we prefer to hide on the front end of the government bond market because of the attractive income.
So wait, I just got back from Davos where we had some great conversations, loads of central bankers, and actually a lot of people asked me, look, was everyone too optimistic? And I don't know whether, if we look back at what happened in the last month, we didn't really know whether we even survived the winter. So is that the market psychology, that actually we're now end of January, we're kind of over the worst for the energy crisis for the moment, and so that's why there's too much optimism?
I think the key here is for the moment. Certainly the warmer than expected winter has provided some relief in terms of energy crises, but also in terms of the relief rally in European assets. But we're not out of the woods in terms of energy supply constraint, and the tragic war is still ongoing in Ukraine. And looking further ahead, we continue to see recession coming, earnings not yet reflecting the recessionary environment that we are entering, which is why we would prefer to stay underweight developed market equities and prefer to stay with a relative preference in emerging markets because of the China reopening dynamics.
And talk to us about that. And before I get to that, Xinyan Kuai, by the way, happy Chinese New Year. So talk to us about the China component. You see growth actually above consensus, 6% for this year. But interestingly, you don't think it gets back to pre-pandemic levels in the medium term. How do you tie that into your views around EM then?
That's right. Happy New Year of the rabbits. Let's hope that the rabbit is less wild than the tiger. That
it's lucky, right?
It should be, yes, I think so. It's shaping up so. In terms of Chinese growth, indeed, we have been above consensus for 2023 growth. Above 6% is our expectation, but the caveat there is really it's compared to a very low basis of 2022 with a 3 handle and also tailing export tailwinds for Chinese growth. But that being our case, in terms of above consensus growth for Chinese economy, we do believe that there is more momentum to come, also in terms of what that means for global growth as well, especially as developed world kind of enters into a recession. So if you look at the Chinese equity market rally, so far it's really been playing to a regulatory relief pattern, right? It is being led by IT. So the reopening theme and the domestic theme has yet to come, which is also why we have a relative preference for emerging market assets over developed market equities at this juncture. But more broadly, with China reopening, it means that the inflationary pressure could prove stickier and more persistent and ultimately changing and impacting the calculus of the developed market central banks.
Wei, thank you so much. BlackRock Global Chief Investment Strategist Wei Li staying with us. Coming up, European leaders fire off warnings over a huge U.S. green spending plan. So we'll have more on that story next. And this is Bloomberg.
The innovation agenda is going full speed on mitigation. That's where, there's 100 companies, Breakthrough Energy's funded.
By mitigation, you mean mostly energy. You mean everything to do with energy. You mean generation of energy. You mean batteries. You mean transport. You mean all of the new, and there's some renewables that are already traditional, but more that need to come out. So that's the package that you're talking about mitigation?
Yeah.
Or are you also talking about agriculture as mitigation?
Yeah, so every area of emissions, the world tends to focus on passenger cars and electricity. That's not a third of emissions. And so the focus on the easiest third, now 4% of new cars are electric, so that's the field that we're furthest along. About 4% of energy generation is wind and solar.
The top names in business are on Bloomberg.
More and more people are frightened of the realities of today, and that's manifesting in so many areas. Why would anybody put something into a 30-year obligation unless you believe something is better in 30 years? I'm not here to suggest it's going to be rosy in 2023, but what I'm saying for long-term investing, it's a better environment for long-term investing today than it was 2 years ago.
Nobody covers business like Bloomberg, your global business authority.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rate World Cup. This is a 3.
As the economic picture down.
Is it the OK's getting ready to make
This is Bloomberg.
Welcome back to the Open. We are 12 minutes into the European trading day. Signs of optimism now across European equities, at least 12 minutes into the trading day. Gains of 0.4, a little over 0.4% across the European benchmark. The futures in the US pointing to gains of between 0.1% and 0.2% on the Nasdaq futures after, of course, that gain of almost 3% on the Nasdaq 100 on Friday. Of course, digesting commentary from Fed officials and the ECB. Slightly divergent picture coming from both of those central banks. Francine.
Now, Germany and France are pushing for a huge spending increase as European businesses so they can compete with their US and Chinese competitors. This comes as the countries push to make their economies more climate friendly. Now, it follows a summit between the French and German cabinets in Paris over the weekend. So for more on all of this, we're joined by Bloomberg senior editor Benedict Kamel. Benny, thank you for joining us. So we also, caught up with quite a lot of the finance ministers of Germany, also the economy minister. Are they now willing, after the summit in Paris, are they willing to go full on and take on the Inflation Reduction Act that the US has put in place?
Well, we heard yesterday from Scholz and from Macron that they want to respond, and how exactly they will respond remains somewhat unclear. They said that they want to, as you say, unleash spending in Europe among European companies. Will this be sort of nation by nation? Will this be an act of European unity? That part isn't quite clear yet. We heard from Scholz last week in an exclusive interview with Bloomberg. He said, we don't want a trade war with the US. So I think that's sort of where they want to get away from. They don't want sort of tit for tat, a trade conflict. That's one thing they want to avoid. On the other hand, unleashing this spending in Europe, how much government intervention will there be? Already sort of the government side has been hollowed out over the past couple of years during the pandemic, during the energy crisis. How far are governments willing to go to support these energies? That really remains unresolved.
And what about in terms of the involvement, the active involvement amongst EU states within corporations, within EU corporations to support them as they face this competition from the US and Asia?
Well, that's exactly a very sticky point. Sort of how far do you go? At what point do you run into your own competition rules? Already there's a lot of discomfort on the EU level in terms of what countries do. Germany has sort of pushed ahead in some areas over the past couple of months, in particular when it comes to bailing out energy companies. So, as I said, how far are you willing to go? There's a bit of a conundrum here for the region. They want to support these energies. We're talking about future energies, hydrogen, batteries, wind and solar. So you want to be at the forefront of that. And you want to push back against the US dominance and a Chinese dominance. But at the same time, as I said, you don't want to hollow out even more the European competition laws as they exist.
Okay, Bloomberg's Benedict Kamel on the latest in terms of the commitments by France and Germany to double down on their support for the renewable sector in the face of that competition, of course, from the US and Asia as well. Thank you. Now, many economists are adjusting their European outlook towards, in terms upwards, I should say, with both Deutsche Bank and UniCredit citing cautious optimism that a recession will indeed be avoided this year. That's as data improves for the continent. BlackRock, however, notes that a European recession cannot be avoided, citing continued sticky inflation readings and growing wage pressures. BlackRock's global chief investment strategist, Wei Li, still with us, very pleased to say. Let's talk about that call then, as increasingly we are hearing, whether it's European officials within the Commission itself or economists suggesting that maybe actually the Eurozone skirts a recession this year. You're a little bit more bearish on the outlook.
Well, I think when we talk about avoiding a recession, there seems to be a bit of a confusion around the drivers of this recession. People are pointing to the milder weather. People are pointing to more resilient consumers as reasons for why we might avoid a recession. But the stronger and the more resilient economies seem to be at this point, the harder it is going to fight inflation, and more over-tightening will need to be carried out by central banks in order to bring about the demand destruction, in order to fight inflation. Because this recession is not caused by excess buildup in the economy as per previous recent recessions, but rather it is going to be caused by central banks over-tightening. So the more resilient economies seem to be at this point, the more over-tightening needs to happen. And the less likely cuts can actually come through later this year as per priced in by markets.
Wait, there does seem to be a belief that actually markets will, or central banks will be very mindful of not on purpose pushing economies in a recession.
I think right now central banks are very focused on fighting inflation at all cost. But at some point, indeed, the focus is going to shift from the politics of inflation to the cost economics of inflation, and that's when central banks would pause. So what you're describing, Francine, is precisely why central banks are not going to go all the way to destroy destruction so much to bring inflation down to 2%. It may be okay with a 3% and settling around 3%, but we really find it hard for them to start cutting when inflation is still above 3%, which is our expectation for this year.
Well, you have the short-term view and then the longer-term view when it comes to how BlackRock suggests you position. How do you look at technology within both of those frameworks at a time when we're looking at the earnings coming through this week, expectations you could see maybe a 9% drop in profits across the tech sector? Do you expect to see further downgrades? How much exposure do you want to get to technology if you have a long-term investment or a longer-term investment view?
If we have a longer-term investment view, actually technology will be an overweight in our sector allocation because it also benefits from kind of the green transition, thinking about the explosive potential that the sector can bring, and also the less carbon footprint that it would entail in comparison with the other sectors. But in the near term, precisely as we enter into earnings reporting season, as we enter into recession, and also given our expectation that U.S. curve needs to steepen to reflect a higher term premium, and also the market getting too complacent about rate cuts, we actually will be wary about entering tech at this point. But if you have a longer term horizon, start building into those positions because there are value opportunities out there.
Wei, thank you so much for joining us. Wei Li there, BlackRock Global Chief Investment Strategist, joining us this morning. Now, coming up, Ken Griffin's Citadel rakes in a historic profit haul, outperforming its peers by a large margin. More on that next. This is Bloomberg.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets. China open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Welcome back to the Open, everyone. 22 minutes into the European trading day. Tom and I are joking. There's quite a lot of football news. And yes, it's not only football news, but it's an Italian club that's being slammed. Dollar weakening against, well, most of the G10 currencies. Many major centers in Asia, of course, closed for Lunar New Year. So overall, we're going to see probably thinner trading volumes. A lot of European stocks gaining some 0.3%.
Okay, I'll give it to you. Juventus just about pipping the news that Arsenal pulled off a 3-2 win versus Man U over the weekend. Let's get to what's happening in the hedge fund space then. This is really fascinating. Ken Griffin's Citadel made a record $16 billion, just $16 billion in profit for clients last year. That is the largest ever return for a hedge fund. Joining us now is Bloomberg's markets reporter Valerie Teitel. How did they pull it off?
Monumental, Tom. 38% return, and that follows on a 26% return last year. Now, to me, this is saying that the multi-manager model that Citadel is running is really here to stay. They have a very diversified set of strategies that they run under different pockets of portfolio managers. And this model, which really has only come around in the last decade, is a huge departure from the bigger hedge funds of the past, which were always driven by big CIO names, you know, using a flashy portfolio name to attract capital, whereas this is very different. This is caused a huge consolidation in the hedge fund industry as these big names pull big macro traders, fixed income traders, equity traders all under one envelope. And it's really enabled Citadel to capture on the big move in bonds and FX and be able to stay nimble because they can direct capital. They can use an asset allocation very quickly in terms of pulling capital from an equity manager and giving it to a bond or an FX manager, which, as we know, was very key last year. If you weren't exposed to these moves in fixed income, these moves in FX, you weren't going to hit those double-digit returns. But to me, this means that consolidation in the hedge fund industry is here to stay.
Yeah, if you're big, you can make some of the greatest trades ever. If you're smaller, a little bit tougher. Valerie, thank you. Valerie Teitel, there, our markets reporter. Now let's get straight to the Bloomberg Business Flash. Here's Alice Atkins. Hi, Alice.
Hi, Francine. Activist investor Elliott Management says it have made a substantial investment in software giant Salesforce. Bloomberg understands Elliott's stake is worth a multi-billion-dollar sum. The investor is known for seeking board representation and pushing for strategic changes. Morgan Stanley has cut CEO James Gorman's compensation by 10% for 2022, a year which saw profits tumble and shares sank. The package includes $1.5 million in salary and a $7.5 million cash bonus, with the vast majority of the total coming in the form of shares. The cut leaves Gorman's total compensation at $31.5 million. Juventus shares fell as much as 15% on Germany's Tradegate after authorities penalised the Italian football team because of how it accounted for player transfers. The 15-point deduction sees Juventus slide to 9th place in the Serie A ranking in Italy. That means the side may now miss out on playing in the European Champions League. That's your Bloomberg Business Flash. Tom, Francine.
Alice Atkins here in London. Let's get back to Francine's favourite story, which is Juventus Football Club being hit with a 15-point fine. This is for allegedly false accounting around player transfers. Importantly for Juventus, Francine, this means that they are likely to miss out then on a spot in the Champions League.
This is like the worst news. I'm a supporter.
Of course you are. I should have reframed that.
This is like a disaster for us.
But you're fascinating what's happening with Juventus, a big hit. If they don't make it into the Champions League, obviously a lot of money there. And so hence the move that we've seen in the stock price, down about 15%, suspended on the back of this news. We'll continue to watch this for you. They are going to appeal, apparently, Juventus, to this penalty that they've been hit with. Of course, they are part of the Serie A, which is the top league in Italy, and it moves them from 3rd place to 10th place. We'll continue to keep across that story for you. Right, coming up. End the tax war and prioritise the UK's green growth. That is what the Director General of the CBI, the Confederation of British Industry, is arguing for. That, of course, as the Europeans and the US double down on their commitments around green technologies. We'll get more analysis after the break. This is Bloomberg.
Paul Jacobson assured me that when he takes the new Hummer EV on long journeys, it's not just fun to drive, it's equipped to go the distance.
I hear so much about road trip anxiety that I wanted to experience it myself. My family likes to drive a lot, so I brought my daughter home from college in this, and it was great. I mean, the computer system is all intuitive. It tells you how to keep track of the battery. It tells you where the charging stations are. It tells you how much power you'll have when you get to the charging station. So it really puts a lot of your anxiety at ease. But as far as driving it, it's a treat.
So where are you on the charging stations? I know General Motors has made an investment in one company. How are we doing in this country generally in getting charging stations in?
So I think this is an area where obviously we can continue to improve as a country and a society. We're doing our best. We've committed almost $1 billion to EV charging. So we've taken that and looked at home charging solutions, local community solutions, and road trip charging solutions. With my daughter, what we would end up doing is probably stopping, grabbing a bite to eat, plugging it into a charger, usually a high-speed charger, to get as much charge as we can, and being there for 20 to 30 minutes. Get us a lot of range, and by the time we've used that range, we're tired, ready to stop again, etc. So it was a really good experience for me, and it's taught me, number one, what are the concerns of the consumer that are ultimately going to drive our vehicles, and then number two, where do we need to focus on addressing some of those anxious points for people?
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. Staking out positions, Fed hawk Christopher Waller says he favors a quarter-point hike at the next meeting. Classic note here in Europe sees at least 2 more 50 basis point increases for the ECB. JP Morgan sees chances of an economic downturn falling across markets while the dollar drops. European stocks trading higher. Plus, Olaf Scholz and Emmanuel Macron warned that European businesses will need to dramatically boost spending to keep pace with the U.S. and China. So, Tom, the market's a little bit more subdued because of Lunar New Year.
Yeah, and certainly across the European benchmark, pairing some of the earlier gains. As you say, major markets, of course, in Asia closed for the Lunar New Year, predominantly, of course, Hong Kong and mainland China amongst the largest. But you're seeing very modest gains now of about 0.1% across the European benchmark. Again, weighing up, as we said in the headlines, what is becoming a divergent picture, it seems, from officials from the Fed, suggesting 25 basis points for the next hike versus ECB, Klaas, not the hawk there, saying he wants to see at least 2 more 50 basis point hikes. That's playing in, by the way, to strength for euro, currently trading the single currency up 0.4% and just short of 109. The DAX gaining 0.1%. The FTSE 100 here in the UK, industrial action again, ambulance workers going on strike, just gaining 9 points, 7,780 for the FTSE 100. Let's have a look at how things are playing out across sectors then. Technology was the barnstormer on Friday out of the US. The Nasdaq 100 closing just shy of 3%. This week will be a major test, though, a stress test of that sector when earnings come through. Top of the list then across your sectors here in Europe, picking up on the gains from the US is technology, getting just shy of 1%. Basic resources also up. There's been a bit of a turnaround in terms of the pricing on oil. It's now gaining. In fact, let me just double check on that. Down, in fact, I should say, Brent is down 0.3%, but you're seeing strength in copper and iron ore. That is what's playing into basic resources, gaining 0.5%. But you do have about 6, 7, 8 sectors currently in the red, led by chemicals, down 0.8%. So that's a picture across the European equity markets. A little touch on the euro there at 32 minutes into your trading session, Fran.
Now, the Director General of UK Business Group, the CBI, says the country's ruling Conservative Party should stop fighting itself over tax and invest more on green energy. Well, joining us now is Charlie White-Thompson. He's Chief Executive Officer of Saxo UK. So thank you, Charlie, for joining us.
Thank you for having me.
First of all, we had quite a disaster weekend for the Prime Minister. He was fined over not wearing a seatbelt. The chairman of the Conservative had a tax bill. There's a penalty, and there's a million other things happening in Westminster. Is that a distraction? Is that why we don't have a growth plan that investors like?
I mean, I'm sure those 2 points are distracting both of the individuals. I mean, it's not a headline that you want to be reading about. But I think at the heart of your question, it's a good one. And I've been doing some thinking about this. And effectively, my view is the UK is a publicly traded company. If you have £2.5 trillion worth of debt, you are a publicly traded company, you have bondholders and shareholders and bondholders, whichever way you want to look at them. And I think, therefore, you need to have a growth strategy. It cannot just be high tax. It cannot just be basically a managed decline.
Are you getting any sense that there is a growth strategy that is being formulated by the Chancellor and the Prime Minister? Are you feeling any optimism that that is going to come to the fore?
I mean, if we carry on with the analogy about the publicly traded companies, so you don't have a Prime Minister, you have a CEO, you don't have a Chancellor, you have a CFO. So that's the way I think about it. And I think that there are 5 points that have been put forward. But I think we need to double down on this because it cannot just be about tax. And I think also it's very important that we debate what I call the sacred cows too. If you are a publicly traded company, you debate the sacred cows. You have to be able to do that if you're going to push on. Otherwise, I think it's very difficult. You know, we are an aging population. The demographics don't look that great. It cannot just be about higher taxes. We need to debate these sacred cows, and we need to have a clear and well-delivered growth plan. But it's not about recklessness.
But why is it so difficult to have one? So the UK Business Secretary was in Davos last week. He laid out a strategy of growth, asking investors to come in, saying it's a small, open economy. You know, there's a mismatch. Are people still scarred of what happened in the autumn? Or does it take longer for them to get back on their feet?
I mean, I think people are definitely scarred from that September budget. And I think that what happened there is that it wasn't well thought out. There were many good things in there. Growth is a good thing. Lower taxes are a good thing. But I think it needs to be better delivered than it was. And for me, are we a value company or are we a growth company? And I would encourage us to look towards the growth company because I think that's the way you basically inflate your way out of this and you deliver on all the aspirations that this country wants to deliver.
Charlie, what are the sacred cows that you want to take to slaughter?
I mean, the sacred cows are, we should start with, number 1 is national health, number 2 is the relationship with Europe, number 3 is the planning laws, number 4 is productivity. The list goes on, and these are the debates that we should have.
Productivity is extremely hard to manage and to get better. So what would you do to fix productivity?
I mean, none of these things are easy, but I think that, we need to get these on the table and we need to think about how we deliver on. There is no, I mean, if there was a silver bullet to dealing with all of these issues, then I'm sure people who are much smarter than I would have dealt with it. But those are, if you ask me the questions, what are the first 4 things that come to my mind? Those are them.
Talk to us about how you want to position and how much exposure you want to have to UK assets. Is it equities? Are you more convinced that maybe gilts is something you want to have in the portfolio? The FTSE 100, of course, a relative outperformer last year. How far do you want to go down the risk spectrum? Is the 250 looking attractive?
I mean, the way I view investing is it's a multi-asset world. So you and I, Tom, we've spoken about this in the past. We've spoken about the Goldilocks economy, where effectively we had an overly stimulated market in the form of QE and low rates. And basically what that did is that gave people a full sense of security. Moral hazard is a bad thing. It gave people a full sense of security on how easy it is to make returns in financial markets. It's not easy. And therefore, I believe in multi-asset. I believe in the ability to be able to trade bonds, the ability to be able to trade FX, the ability to be able to trade equities. And within the UK, it's not just about buying UK. It's about being able to have access to global instruments. And I said it the last time, I'll say it again, is that if your wealth manager doesn't provide you with these tools, then you should consider, do I have the right wealth manager?
Yeah. But Charlie, just on the point of Europe, we are seeing from all sides of the aisle wanting to be closer to Europe. What kind of relationship do you think the UK will have with the EU at the end of this?
I think we should be close, but I think that, the country voted to leave Europe, and therefore I think that it's my opinion that people need to get behind this, and we need to take advantage of all the advantages we have. So if we think about ourselves as a publicly traded company, what are our advantages? How can we do this? How can we best position this country going forward? These are the big questions. These are the big questions for me. I'm not talking about isolation. I'm just talking about taking advantage of our skills and our skill set, which is not a bad thing.
And as kind of the longer term view, as we focus on the here and now, some of the economic data has actually come in slightly higher than many had expected. Our own team at Bloomberg Economics last week saying, you know what, we're feeling a little bit more optimistic about the UK's growth trajectory this year. What is your assessment of the macroeconomic outlook for the UK?
I mean, overall, globally, it's been a good start to the year. So you've seen good stock markets, particularly in Europe. I thought Davos was a very positive affair. So that was about stock markets, that was about energy prices lower, that was about China's policy on COVID, that's about the big policy coming out of the US on green. And so therefore there are, I call these green shoots, there are green shoots, and we need to build on them, and we need to encourage them, and we need to stimulate them. But we're not out of the woods yet. And when I say that, I say the enemy number one for me, we said this the last time we spoke, is inflation. And with inflation at 10.5%, when your target is 2%, if you lift the bonnet on that, you are seeing things like food inflation up 17 months in a row. The last time we did that was in September 1977. We need to deal with that if we're going to push on.
All right, Charlie, thank you so much for the insight. Charlie White-Thompson there, Chief Executive Officer of Saxo Markets UK. Now, this is a picture for Juventus. It hurts me to pain to say it. First of all, I am reminded almost on an hourly basis that it is a penny stock. Yes, it is. So shares were to 29 euro cents. Now they're about 30, again, from 33 euro cents. So these are, you know, very, very small changes that make a huge difference because it's down some 12%. And this is on the back of authorities in Italy really penalizing Juventus, one of football's greatest a long time ago. Now they're in a bad league, but they did cut its point standing because of how it accounted for player transfers, and that's really hurt, of course, the expectation of them winning anything at all. The share price down 11%. Coming up, the real estate rut is set to spread from housing to commercial markets, also from London and Frankfurt to the rest of Europe. So we'll talk more about real estate next. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
News breaks. No one covers the world like Bloomberg.
In addition to him pleading not guilty, as we had expected, to 8 criminal counts here, there's a lot else that happened.
1 million people are getting infected every day, and that's going to rise to 3.7 million by January.
The UK is the only G7 economy that hasn't returned to its pre-pandemic level yet.
Bloomberg, your global business authority.
Welcome back to the Open, everyone. 42 minutes into the European trading day. For the moment, we're holding on to most gains. The CAC 40 turned a little bit, pretty much flat. And then the big story is, of course, what's happening in currencies with dollar declining. But overall, European equities are a little bit better than they were last week, Tom.
And one sector that remains in the green, real estate up 0.6%. We're going to stay on that topic because European real estate is actually experiencing its highest distress level in decades. That's according to recent research. Bloomberg has compiled data showing that around 175 billion of real estate credit is already facing repayment headwinds in both housing and commercial markets. To get the context and analysis, let's bring in Nicole Lex from Bayes Business School, Senior Research Fellow. Nicole, good morning. Thanks for joining us.
Good morning.
Let's start there then. How problematic is this? We're hearing now reports that maybe commercial lenders, or at least lenders, are not prepared to lend on commercial real estate. UK commercial property values fallen 20% in the second half of 2022. How dire is the picture?
Yes, what we see with our survey, and we are now restarting talking to all the lenders, and we speak to 100 lenders throughout the year. It really shows that because their risk costs have gone up for commercial real estate, specifically because the credit quality has declined, they are definitely less willing to look at new lending. I mean, there will be a lot of activity looking at refinancing loans, but looking at new loans, new borrowers, there's going to be less liquidity and appetite.
So are we going to see, Nicole, actually some companies going bust because of this?
Well, there is still a lot of equity in the sector. So we will see, obviously, developers will be the first ones, or amongst the first, to probably run into trouble because they have to really complete developments. And if they run out of financing or they're hit with really high financing costs, they run into delays. And then if that obviously could lead to some insolvencies on the developer side. Other companies, like property companies, REITs, they have a lot of cash, but they will see their returns really decline and even going into negative returns.
Is this an orderly unwind, or are we starting to see evidence of a disorderly unwind?
Well, depends how disorderly and how you define disorderly. Our prediction is that we will see some unwinding, but to a lesser extent than in the previous crisis during the GFC in 2008-9. How deep or how much the decline or how much the distress will be, whether it's more or less, will also depend on how the economy is going. If on top of it we see low retail sales, less consumer interest in the retail, so then retail assets are going down. If people are not going back to offices, office sector, rental decline, then again, offices are going to do worse. So it depends a bit on the combination. And I guess we have a lot of risk factors right now, or uncertainty in the economy, that there could be, some more problems coming ahead.
So, Nicole, of course, if you cannot delay refinancing, this is a huge issue. Who has most to lose? Is there a part of the market that looks most vulnerable?
Yes, that's a very good question. And so obviously, exactly, the refinancing is a problem. So what we've observed over the years with our data is we expect to see about 20 to 25% per year on a rolling basis to refinance of all the sort of loans. And so that is a significant amount. And obviously, who is first hit are those that, they haven't hedged. That's the key problem. I mean, some might be still fine if you have your interest rate is hedged, and until a certain amount, you can delay the refinancing and you can delay the effect of being possibly hit by really high refinancing rates right now. So everything that's floating rate and coming up for refinance, that's going to be problematic. And again, that is development finance is usually short term. Any bridging finance, anybody who has used intermediate solutions like bridging and mezzanine finance needs a quick solution, and they're going to be the ones in more trouble.
Are you seeing, is this an opportunity for cash-rich buyers? Are you starting to see cash-rich buyers, whether here in the UK or based outside, I think Middle East, elsewhere, coming and swooping in?
Yeah, I mean, absolutely. I mean, where there is a loss on one side, there is an opportunity for other people, obviously, and as property values correct, it's a brilliant time. At the same time, if you have equity and you can buy at the right price, and this is where the opportunity is. Whether there is going to be a lot of Asian buyers, considering now the problems that are happening in China, there's always a foreign investor group that will come, I think, into the UK market. You will see US investors as well that are typically coming at this time round when rates are really interesting to them. Europeans, probably less so. They will stay in their home markets. So it depends on the global capital flows, but people will pick up opportunities.
Nicole, thank you so much for joining us today. Nicole Lux there, Senior Research Fellow at Bayes Business School. Now let's get straight to the Bloomberg First Word News with Alice Atkins. Hi, Alice.
Hi, Francine. Germany and France are warning European business will need to unleash investments on a massive scale to keep up with the US and China. Leaders of the two countries met in Paris to discuss how the EU should respond to President Biden's Inflation Reduction Act. The bloc argues Washington's plans unfairly subsidize US companies. A top health official in China has suggested more than 1.1 billion people have been infected with COVID since virus controls were abruptly dismantled late last year. In the week leading up to this weekend's Lunar New Year holiday, Beijing's official death tally was about 12,500. The World Health Organization is urging China to release more detailed information on the outbreak. Incoming New Zealand Prime Minister Chris Hipkins says he will prioritise the economy as a recession looms and may drop some of Jacinda Ardern's policies. Hipkins is seeking to win back the political middle ground ahead of an October election, with his Labour government trailing in opinion polls. He says he's heard the message from some voters that the government is doing too much, too fast. California police say a man who killed 10 people on Saturday night at a ballroom dance club east of Los Angeles killed himself as officers closed in. 10 other people were wounded in the shooting in Monterey Park following a Lunar New Year celebration. Armed officers surrounded a white van about 50 kilometers from the scene of the attack before the suspect shot himself inside the vehicle. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom, Francine.
Okay, Alice Atkins here in London, thank you. Coming up, Bloomberg has learned that an activist hedge fund, not just one activist hedge fund, a very prominent one, has taken a big stake in Salesforce. We're bringing the details on that scoop and what it could mean for Salesforce going forward. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Was going to keep Green World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question. Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Welcome back to the Open. 52 minutes into your European trading day this Monday morning. Gains of 0.2% across European equities. Morgan Stanley's Mike Wilson saying that the macroeconomic data is overwhelmingly weak and has not yet been priced into these markets. The futures are flat in the US after a very solid run on Friday. The Nasdaq 100 closing up nearly 3%. And as a result of that, you've got technology as the lead sector here in Europe, gaining 1.2%. Francine.
Now, activist investor Elliott Management says it has made a substantial investment in software giant Salesforce. Bloomberg understands that Elliott's stake is worth a multi-billion-dollar sum. Now, the investor is known for seeking board representation and pushing for strategic changes. Well, joining us now is Bloomberg technology reporter Aggie Cantrell. Aggie, great to speak to you. I mean, it's the chief executive's worst nightmare to have an activist investor like Elliott on your back, especially as Salesforce is going through huge changes.
Yes, exactly. So we're seeing at Salesforce, we've seen massive changes. Even in the last couple of weeks, we've seen them cut staff by 10%, say that they're reducing office space. But we've also seen that the company more broadly has had a real issue with keeping that pandemic market cap. In 2021, its market cap went up to $300 billion, and now it's around half of that. And so what we're seeing from this move now is essentially a need to translate Salesforce's performance into market performance. And that's what's going to happen with Elliott coming on board potentially. We're seeing as well that that people have left the company. Top executives, including the co-CEO and the former founder of Slack that was brought on board, have both left the company in recent months. So it's part of a potential plan to turn around the company and actually make sure that its market cap gets back up to what it was in 2021.
And it's a big stake from what we're hearing. And they came out with a statement pretty supportive of Benioff. How concerned should the team at Salesforce be?
I think that's a crucial part of it, Tom, that essentially Benioff is seen as a steady hand at the company. And we've also seen that even in that statement, Elliott was making it clear that they thought that he was good for the company. And so, but we have also seen in the past when Elliott has taken stakes in, for instance, PayPal and Pinterest, the market has seemed to like that. They see Elliott as potentially an investor that can help push a company's performance for its shareholders. And so we've seen when we've seen recent moves also in other companies like PayPal and Pinterest, we've seen that perform well on the market.
Aggie, big week for technology. I jumped in there, Francine.
No, sorry.
You've got a question. Well, we'll maybe do a double act on this one, Aggie. We're very keen to talk to you about this. So, of course, a big week in terms of the earnings coming through from the tech sector. What are you and the team going to be looking for?
I think what we're going to be looking for is looking for more communication post these recent job cuts. These job cuts have sent shockwaves through big tech. We've seen them in so many different companies now, but also we've seen the big players getting in on the job cuts, including Google only on Friday last week. And so what we're going to be expecting is some more communication of what these job cuts actually mean for the growth of these companies. Is this just a question of them overhiring during the pandemic, or are there real strategic moves to be taken in the next couple of weeks when it comes to where big tech is going to be able to navigate a potential downturn?
Okay, Bloomberg technology reporter Aggie Cantrell in Berlin. Thank you very much for the update and the preview, of course, of a big week for earnings out of the tech sector and, of course, that activist investment in Salesforce. Just checking on your markets then. European equities currently posting gains of 0.2%. The futures are flat in the US. Of course, it is the Lunar New Year here. Holiday in much of Asia, so mainland China, Hong Kong closed, but across the MSCI Asia Pacific, gains of 0.5%. Euro dollar rallying 0.4%, 109 on the back of pretty hawkish comments from ECB officials out of the Netherlands, pushing and stamping their hawkish narrative on these markets, Francine.
That's it for the European market close. Well, open rather. Your surveillance early edition is up next. This is Bloomberg.
digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's
doing
weird.
Like a weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg. This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance, Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Fed hawk Christopher Waller says he favors a quarter-point hike at the next meeting, while Klaas Knot here in Europe sees at least 2 more 50 basis point increases for the ECB. JP Morgan sees chances of an economic downturn falling across markets. The dollar drops with European stocks trading higher. Plus, Olaf Scholz and Emmanuel Macron warn European businesses will need to dramatically boost spending to keep pace with the U.S. and China. Now, first thing is first, let's check on the markets. We are probably going to see thinner volumes than usual because of the Chinese Lunar, so a lot of financial centers in Asia will be closed. European stocks pretty much unchanged, maybe gaining some 0.2%. We're seeing energy, of course, one of the biggest gainers in today's trading session. The dollar index, 1,222. If you look at euro dollar, that's probably the most interesting currency. This, of course, is on the back of some of the differentials when it comes to interest rates. The dollar actually slipping. Stocks, though, are gaining after we had a lot of Fed speakers maybe sounding a little bit more dovish than usual. Let's also get to the European map. Again, there's not a huge divergence of the fortunes of some of these European stocks. The FTSE MIB down 0.2%. Juventus, I know it's a penny stock, but it's down some 10% after it lost quite a lot of points because of accounting irregularities. The picture for the FTSE getting 0.2%. So there has been muted trading in Asia. Many markets closed, as we were saying, for the Lunar New Year. So that's the very latest on what we're seeing. However, Japan stocks did close up. Prospects for slower policy tightening by the Fed lifted investor sentiment. Now, for more on all of this, we're joined by Luke Hickmore. He's investment director at Aberdeen. Luke, good morning. Happy Monday. What's the week looking like?
Difficult, I think. It's easy to get sucked into these equity rallies and bond rallies that we've been seeing over the last few months. But we start seeing earnings season kick off in earnest this week. A lot of tech earnings coming out of the US as we go through the week. And I think that might temper some of the enthusiasm we've seen for risk over the last month, 2 months in particular.
So, Luke, talk to me a little bit about, what we've seen overall. When you look at some of the concerns out there, I don't know whether it's the market not understanding what the Fed will do and how aggressive it can be.
So, yeah, we've still got different Fed members telling you different things. That 25 basis points from one and 50 basis points from others. I think they are still keen to push those rates up and actually get the US economy into negative growth, possibly even recession over the next 6 months or 7 months. And the market seems to be kind of ignoring that a little bit and saying, look, we want to buy, there's lots of cash on the sidelines, let's get it involved, let's move on and, and actually get some growth going. But, the Fed's still there, it's still going to hike, companies are going to find their earnings coming under increasing pressure as the year goes on. I sometimes think we forget that lower inflation does not mean lower prices. Consumers are still going to be finding the year pretty hard. And that all needs to come out, I think, over the next month or two to really reset the market to a much more better valuation level for the risks that we face going forward, whether those are inflation or interest rates or war risks still in Ukraine, of course.
Yeah. So, Luke, where do you see the most interesting part of the market? Is it currencies, or do you actually play some of the equities? I don't know if it's on the back of earnings or margin squeezes.
I'd be nervous chasing equities here. I think investment-grade credit is probably a decent place to be, but even that short-term feels a little bit expensive, and I'm an investment-grade credit manager, so it's always easy for me to say my market's brilliant. But I think just short-term, even that looks expensive, particularly in dollars and euros. A little bit better value maybe over in sterling, and you can find pockets of value out in the Far East, as we've seen with our emerging market teams. But even that needs to kind of correct a little bit to reflect the risks that recession really is coming, even though that seems to be fading off the radar a bit.
Luke, let's also bring in Heather Burke from our Bloomberg EvLive team. Heather, good morning. Thank you so much for joining us. When you look at classic note and actually what's happening in the ECB, are we going to see more interest rate differentials, and what does that mean for currencies?
Definitely. On the one hand, you have the Fed, like Christopher Waller, saying, okay, we're 25 basis points look in, we're seeing some slowdown. Maybe that Fed pivot's coming. On the other hand, in Europe, in the euro area, you've had all these central bank speakers from Klaus Knott, Olli Rehn saying, okay, we are not where we need to be. We need to keep hiking. 50 basis points seems pretty baked in for the February 2nd meeting. And so, yeah, we are seeing this differential. At the same time, the euro area economy, still there's a lot of soft patches, but the energy crisis has eased. And, we're seeing maybe the worst case recession scenarios have been averted. That being said, the ECB doesn't want to take the foot off the gas. They want to put rates in restrictive territory.
Luke, what does that mean for your expectations of what the ECB can do? Again, there was a Bloomberg story, citing sources last week saying that we could see, the end of the 50 basis point hikes, but I don't know whether that deals with inflation the correct way.
It's not the only thing we've got to worry about with the ECB as well, of course. The 14 to 16% that they own in the European corporate bond market needs to get unwound as well. So it's not just these rate hikes that we've got to get through. It's the QT that we're going to be seeing after that, and a massive amount of sovereign issuance that, close to 500 billion net by most people's estimates over the rest of the year from Europe as a whole. So, ECB's not just there on the horizon as the concern for investors in Europe. And I think, again, the euro seems to be running ahead of itself a little bit. The fall off in the dollar, in particular DXY, down to levels we saw last April, seems too far right now for those risks that we see going forward. And Heather, I love the MLive blog, by the way. Some great notes this morning on the euro.
So congratulations, take it. It is a wonderful blog. Heather, what are you focusing on next, actually, when it comes to currencies or even bonds in Europe?
I look at the whole story overall. You've had European outperformance. I'm a stocks geek, and you've really seen European stocks. They had one of the best quarters ever in dollar terms versus the S&P 500 in 4Q. You've seen that outperformance continue. I think part of that's the overall ECB, the hiking story, the economy and energy averting these worst case scenarios. I'm going to really be looking at earnings as a kind of make or break for stocks on both sides of the Atlantic. You had Simrise out today, a chemical company, and they've had some margin issues. They're down, and that is a really big banana peel for stocks on both sides of the Atlantic. The U.S. this week, we're going to start to see some of those big tech readings with Microsoft and Tesla, and that comes with a lot of job cuts. Are they going to kind of be able to produce the same kind of growth that kind of seems baked into some of these stocks?
Look, what do you do with a lot of the tech stocks and names?
Oh, I think it's tough. I think, you could look at this as a long-term opportunity to just ease in a bit of dollar cost averaging into what are some great names, but you want to be, I think, probably at the top of the pile, the quality names in that space, the Microsofts, the Google Alphabets, the Masks, those kind of businesses, rather than kind of chasing the smaller players in those markets who I think are going to find it really hard. I agree on the margin side completely, and we are going into a season in Europe in particular where we're going to be talking about earnings, and we're going to be talking about bulk negotiation of wages across Germany in particular, which could be 10% this year. So yeah, margins all year long.
Great. Thank you both for joining us. Luke Hickmore, their investment director at Aberdeen, and Heather Berg from Bloomberg Markets Live. Now, this is a picture overall for, well, Salesforce. Hedge fund Elliott Investment Management has taken a substantial, and when I say substantial, I mean it, activist stake in Salesforce, making it move after layoffs and a deep stock swoon at the enterprise software giant. Now, on the back of Elliott's investment, the stock price is gaining some 4%. Elliott, one of the most aggressive, actually, activist shareholder, often pushing for strategic changes, often seeking board representation. We understand took a multi-billion-dollar stake in the company, and of course the market cap of Salesforce now $151 billion, down from a peak of more than $300 billion back in 2021. Coming up, European leaders fire off warnings over a huge U.S. green spending plan. We'll have more on that story next, and this is Bloomberg.
The innovation agenda is going full speed on mitigation. That's where, there's 100 companies, Breakthrough Energy's funded. There's
by mitigation, you mean mostly energy. You mean everything to do with energy. You mean generation of energy. You mean batteries. You mean transport. You mean all of the new, and there's some renewables that are already traditional, but more that need to come out. So that's the package that you're talking about mitigation? Yeah. Or are you also talking about agriculture as mitigation?
Yeah, so every area of emissions, the world tends to focus on passenger cars and electricity. That's not a third of emissions. And so the focus on the easiest third, now 4% of new cars are electric, so that's the field that we're furthest along. About 4% of energy generation is wind and solar.
Do you think today it's easier for a black entrepreneur to start a company, or no more easy than it was 20 years ago or 30 years ago?
If it were easy, you would see more Bob Johnsons, more Michael Jordan, more Magic Johnsons, and Oprah Winfrey's and the like.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, France and Germany are pushing for huge spending increases so European businesses can compete with U.S. and Chinese rivals. It does follow a summit between the French and German cabinets in Paris over the weekend.
Es ist notwendig, dass wir
It is necessary that we handle the inflation reduction aid and formulate a European answer. Firstly, we have to make sure that, as a European Union, we are not treated worse than neighboring countries such as Canada or Mexico. And it cannot be accepted that the many local content regulations that are in there cause discrimination of European businesses and their activities in the U.S.
Unternehmen bei ihren Tätigkeiten, Aktivitäten in den USA bedeuten.
Now, for more on all of this, we're joined by Bloomberg senior editor Benedict Kamel. Benny, thank you for joining us. So tell us a little bit more about what was actually discussed at the summit in Paris.
So the summit between Macron and Olaf Scholz, the German chancellor, in fact, the entire cabinet of Germany flew over to Paris for this. And one big topic was, how do you counter President Joe Biden's Inflation Reduction Act, the IRA, which is essentially a $500 billion sort of act to get future technologies, future energy off the ground, do more sort of for Buy American and create a huge counterweight to what's happening in Europe and what's happening in China. There is that concern, and we heard it just now from Olaf Scholz, saying we want to make sure there's a level playing field. We want to make sure that we're not treated any worse than the direct neighbors of the US, Mexico and Canada. But how do you do that? You can either go the official complaint route down the WTO. That'll probably take years, and it's unclear where it'll take you. And what they've now decided is they want to create something similar over here, a similar push that will keep companies here in Europe, because there is a concern that companies will look at what's happening in the US, they will move business over there, and during times of sort of economic difficulty, that's the last thing you want.
So, Benny, is this a sign that EU governments are moving towards more active involvement in companies?
It sounds that way, but it's unclear how exactly how would that shape out. Would it be a universal effort across Europe? Would it be country by country? We've already had a lot of sort of countries doing their own thing. In Germany, we had efforts to stabilize the energy sector, to stabilize the aviation sector, and so on during the pandemic, but also now during the energy crisis. And you want to make sure that not every country does its own little thing, but that there's a universal effort. So how exactly that'll work out, that is unclear. France and Germany being the two dominant economies coming together, that'll probably go a long way, but there's a lot of left unknown in the detail. There are further meetings planned today by the foreign ministers. There are meetings by the leaders in the next couple of weeks. So the intent is there, but how exactly that'll shape out and how you make sure that you don't hollow out the European competition laws, that remains unresolved.
Benny, thank you so much. Bloomberg's Benedict Kamel, they're joining us on this very latest summit. Now, Ken Griffin's Citadel made a record $16 billion in profit for clients last year, the largest ever return for a hedge fund. Well, joining us now is Bloomberg's markets reporter, Valerie Teitel. Valerie, I mean, the numbers are incredible. 16 billion in profit, 12 billion in fees. And it does seem like you're either Millennium or Citadel and have a very different strategy, and you're really killing it. Or you're like Rokos and Brevin Howard, and you did for bonds, and you also did very well.
Yeah, it's really all about this multi-manager model, which you mentioned a lot of these big hedge funds are running now, Citadel, D.E. Shaw, Millennium, which allowed them to return these just incredible numbers last year. You know, the multi-manager model allows them to have a wide range of strategies across different assets, and each of these teams have a niche focus and a specific trading style. And it allows, Citadel in this case, to allocate capital to within the fund to these specific styles which they think are going to be successful. Last year, it was all about being exposed to movements in bonds and FX, and if you didn't have that in a big way in your portfolio, you were going to miss out. But this is all overlaid with a risk management approach that allows them to navigate from having specific blow-ups under one trader. It's diversified, and it's showing it's going to be the model for the industry. It's really taken the baton from the equity long short funds of the past. The tech bubble bursting really showed a lot of weaknesses in their model. And a further shift away from the single manager models of the past. It's no longer going to be
unless you're a macro. If you're a macro, if you're Brevin Howard and Rokos, then you've done also pretty well in shorting some of the bonds.
Yeah, those guys did extremely well last year. But the thing about that model, Francine, is their assets under management is in some way capped. right? These multi-managers can have a huge array of assets. You know, Citadel runs over 60 billion, and it's hard to see that being run under one specific manager in a macro model.
Valerie, thanks so much. Valerie Teitel there, our Bloomberg Markets reporter. Coming up, a UK business group warns Rishi Sunak's government what he needs to focus on for green growth. So we'll dig into that story next. This is Bloomberg.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
So the UK's ruling Conservative Party has been told to stop fighting with itself over tax and prioritise green growth. Now, the warning shot has come from the Confederation of British Industry, a prominent business group. Well, joining us now is our UK correspondent, Lizzie Burden. Lizzie, first of all, tell us, good morning, tell us a little bit about this call by the CBI to push green investments in the UK.
Well, the US, of course, has got its Inflation Reduction Act. Last week, we heard from Brussels calling for unprecedented investment into clean tech. So this is the CBI telling Britain to step up to the plate. You've got Tony Danker in his speech this afternoon calling for deregulation and for state funding. And of course, he's not the first to call for it. You were in Davos last week. You spoke to the Shadow Chancellor, Rachel Reeves. She said, don't carp on the sidelines about what others are doing. Get on with it yourselves to the government. And in fact, a government-commissioned report by the former Tory Energy Minister, Chris Skidmore, earlier this month, also said that net zero is the growth area of the 21st century, but it's the inertia at the moment that's holding back jobs and investment. And actually, the CBI's research today shows that by 2030, the UK will have lost the value of £4.3 billion in terms of battery production and hydrogen market share. So this is something of an international green arms race.
Lizzie, at the same time, it's cold. It's very, very cold. There's like this, wave that we probably brought over from Davos here in the UK. Does it mean that we're going to use more coal?
Well, it might have done. Overnight, National Grid had asked for 3 coal-powered units to be fired up, to be put on standby, because you've got freezing temperatures and low wind power, so more demand and lower supply, but actually National Grid has stood down the units. What's interesting, though, is that people are still going to be paid to reduce their consumption between the hours of 5 and 6, peak time, and so it shows that the UK is getting into line with the rest of Europe in terms of not just using supply-side policies, but also demand-side.
Lizzie, thank you so much. Lizzie Burden there with the very latest on the UK. Now, we'll be covering all things UK every week on Thursdays at 9:30 a.m. in our half-an-hour UK special. Now, let's get straight to the Bloomberg First Word News. Here's Alice Atkins. Hi, Alice.
Hi, Francine. A top health official in China has suggested more than 1.1 billion people have been infected with COVID since virus controls were abruptly dismantled late last year. In the week leading up to this weekend's Lunar New Year holiday, Beijing's official death tally was about 12,500. The World Health Organization is urging China to release more detailed information on the outbreak. Germany's foreign minister has suggested it wouldn't stand in the way if Poland sent Leopard tanks to Ukraine. The German defense minister meanwhile acknowledged for the first time that Ukraine will need battle tanks to regain territory. This as former UK PM Boris Johnson travelled to Kyiv, urging the West to double down on support for Ukraine. Incoming New Zealand Prime Minister Chris Hipkins says he will prioritise the economy as a recession looms and may drop some of Jacinda Ardern's policies. Hipkins is seeking to win back the political middle ground ahead of an October election, with his Labour government trailing in opinion polls. He says he's heard the messages from some voters that the government is doing too much, too fast. California police say a man who killed 10 people on Saturday night at a ballroom dance club east of Los Angeles killed himself as officers closed in. 10 other people were wounded in the shooting in Monterey Park following a Lunar New Year celebration. Armed officers surrounded a white van about 50 kilometers from the scene of the attack before the suspect shot himself inside the vehicle. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine?
Alice, thank you so much. Juventus Football Club actually falling some 12% just now. This is on the back of, Italy saying that they will take about 15 points away from the club, and this is because of alleged financial manipulation or how they accounted for player transfers. Coming up, millions mark Lunar New Year across Asia as the region celebrates a holiday without COVID restrictions, so we'll have plenty more on that next. And this is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid,
we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
The top names in business are on Bloomberg.
More and more people are frightened of the realities of today, and that's manifesting in so many areas. Why would anybody put something into a 30-year obligation unless you believe something is better in 30 years? I'm not here to suggest it's going to be rosy in 2023, but what I'm saying for long-term investing, it's a better environment for long-term investing today than it was 2 years ago.
Nobody covers business like Bloomberg, your global business authority.
Christopher Waller says he favors a quarter-point hike at the next meeting, while Klaas Knot sees at least 2 more 50 basis point increases from the ECB. JP Morgan sees chances of an economic downturn falling across markets. The dollar drops with European stocks trading higher. Plus, Olaf Scholz and Emmanuel Macron warn European businesses will need to dramatically boost spending to keep pace with the U.S. and China. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, for the first time in years, well, millions of people have been able to travel across Asia to celebrate Lunar New Year without restrictive COVID rules. China's abandonment of its zero-COVID policy has given the travel sector a boost, while also raising concerns it could lead to a spike in cases across the region. Well, joining us now is Keiyu Jin, Associate Professor of Economics at the London School of Economics. Keiyu, as always, thank you so much for coming on. How do you see the China reopening going?
Well, it's a tricky time. It's one for festive seasons, and the forbidden fruit consumed in Beijing with fireworks blasting off indicates one thing, that some people are ready to move on, to invite, to welcome a new cycle of renewal. On the other hand, there are costs of economic reopening for practically every family. So it is a tricky time, but people are looking forward.
So, Keiyu, talk to me a little bit, and what you're extremely good at is really looking at the nuances of reopenings, what this means for urban China, what this means for rural China. Are we going to see many divergences?
Look, in China, there's currently right now not only pent-up demand for consumer spending, but also a pent-up determination for everybody, whether it's the government, the companies, the households, urban areas, rural areas, ready to welcome really a new beginning after years of prolonged lockdowns and economic downturns. The urban inequality and rural inequality has widened because of the pandemic, but government fiscal spending, fiscal expansion, which will be a focal point for policymakers, are also aimed at, rebuilding household balance sheets and supporting, especially those who have been hurt during the pandemic, and that includes rural households.
So, Keiyu, what does pent-up demand look like? Is it goods first? Is it luxury goods and then on to services?
Well, the Chinese consumers respond slightly differently from the, let's say, consumers in other countries. With reopening, they had built up a lot of saving over the pandemic, but they're not going to just go out and spend on large durables and large amount of spending, because it's a lot of precautionary saving. There's still a lot of uncertainty in the Chinese economy. Confidence has to rebuild. But in the short term, I can assure you that all families are looking forward to go out there, spend on discretionary services, travel again, and short-term spending will be up. But there is long-term or longer structural problems, structural issues in the economy. It's not as if we would just open up the economy that all of the economic woes in China would be solved. You have the large, debt issues, debt overhang, the fact that companies, those who are still surviving, because billions of them have gone bust over that cycle, look at, how do they rebuild their businesses? And the fact is the economy is not really like what it was 10 years ago for China anymore. It's not easy to stimulate the economy as it was when the property was thriving. So these stimulus policies don't work as effectively. There are significant headwinds despite the short-term boost.
So can you give me a sense of what that means actually for, some of the policies put in place going forward? So we know that also the economy, policymakers, even the central bank has tried to support the economy. Will that be the main story for 2023 as well?
Well, it's a delicate balance because we need to think about financial fragility as well, and that's on the minds of the Chinese government. How do you, all eyes are now focused on growth, yes, but once there is significant pickup, they have to turn to maintaining the financial system problems and financial fragility. So I think there's a lot of room for fiscal capacity. There's also more of a lax monetary environment. But again, once the economy normalizes, we can also expect interest rate hikes again, whether it's to fight off potential inflation or to preserve the financial system. So it's a tricky balance. But everybody is aligned to refocus on the economy. And that goes to show that pragmatism and legitimacy ultimately go hand in hand.
Thank you, Kay. Let's also bring Diana Choi-Leva, Chief Economist at Inodo Economics. Diana, we're just talking there with Kay Jin about what kind of economy, I guess, China will see in the next 12 to 18 months. What's growth looking like, Diana?
Well, first, let's see how we get through the Chinese New Year and this largest human migration, which will spread another wave of COVID infections across rural areas, where the population is less protected for a variety of reasons. Beyond that, the authorities are intent on getting the economy going from the spring onwards, and very much using the old model, if you'd like, credit-fueled, investment-driven expansion. There is some pent-up consumer demand. However, consumer spending has been in the doldrums for a variety of reasons, and reopening or the very strict lockdown restrictions were not necessarily the main one. So over the long term, growth is highly unlikely to reach the pre-pandemic rates. But in the very short term, if we go through this next couple of months all right, and the Chinese Communist Party's gamble pays off in terms of the abrupt and unprepared opening up, then we are looking actually at quite a significant short-term upswing.
So, Kay, and thank you, Diana. We'll come back to, of course, this idea of how the economy also changes. Kay, you're in Beijing. How is travel actually looking like? So we understand there's no restrictions. Is everyone going back home? Certainly, there'll be more people going back home than 2022. Do you worry about, the COVID situation?
I look out my window and I just see traffic everywhere, traffic like we've never seen before for years. And the airports are full, and people have just said, look, it's been 3 years since I went home to the rural areas or wherever. Everybody's going around. And there's a sense, at least in urban areas, that this wave of pandemic is over. So let's try to enjoy the freedom while we can, and we'll worry about the second wave later. So I do sense that there's this excitement, there's willingness to go out, but work and rebuild and spend. But, we don't know when the next wave is coming, but hopefully the country will be more prepared and there will be less psychological trauma the second time around.
Diana, what can you tell us about soaring unemployment and, maybe concerns about the income outlook?
Look, clearly, the lockdown sort of zero or dynamic zero COVID policy had driven the economy into the ground. One particular worry is the high rate of unemployment, in particular among the young, those between 16 and 24 years. And this is a key challenge for the party. They have been actually battling with it for the past over a couple of years, including all sorts of measures along the lines of pressurizing state companies to hire interns, even unpaid interns, just to help out with that problem across the younger generation, who are also the ones that kick-started the protests in November, which were largely a surprise to the authorities, even though they managed to get a handle on them very swiftly.
And, you know, given all of that, we did see, as I think you were saying, you know, Chinese leaders making domestic demand a priority. There have been analysts that have been calling for cash handouts, like we maybe saw in the US, to support, you know, some of the policies that they've already put in place. What do you think government support looks like from here until the end of the year?
Well,
one of the key differences between Chinese policy response.
Sorry. Let's do KU first, and then Diana, I'll ask you the same question.
One of the first responses, the key differences between the Chinese and the Western government was that the Chinese focused on supporting the firms in the beginning of the pandemic and not necessarily the households. And now we see a large deterioration of household balance sheet as well, and a large amount of, you know, a large number of unemployment and precautionary saving, as we mentioned. Now the focus is back on consumers and household welfare. So a lot of the fiscal policy should be, and I think will be, directed towards supporting households, but at the same time giving firms, small and medium-sized companies, also a boost as well.
Thank you, KU. Diana?
That is very much the case in terms of what the authorities are trying to achieve. But of course, they don't have full control of households who, for a variety of reasons that continue to be salient, have this higher precautionary saving desire. So in order to get quickly the economy off the ground, there is a huge fiscal boost aimed at infrastructure spending as well. More generally, I would argue that removing the dynamic zero COVID has removed what was a short-term constraint on people's ability to simply go out and shop, and of course the psychological impacts of the huge uncertainty, which is likely to continue to cause precautionary saving even after the change in the authorities' pandemic measures. And also, China has not reversed in any shape or form its common prosperity idea, this redistribution of income and wealth, you know, from the rich towards the poor, which is a key reason why the well-off urbanites are not out spending in droves.
Yeah. We'll have plenty more, of course, on China throughout the day and the week. Thank you both for joining us. KU Jain, Associate Professor of Economics at the LSE, and Diana Troileva, Chief Economist at Enodo Economics. Coming up is a bankruptcy of Genesis, one more blow than the crypto lending industry can withstand. We'll get more of that next, and this is Bloomberg.
a digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
Like a weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacroix here in London. Now, crypto lending firm Genesis has filed for bankruptcy, becoming the latest to collapse in the aftermath of FTX's swift downfall and last year's rout in digital assets. Is the news the final nail in the coffin for crypto lending? Well, we're now joined by Matteo Dante Peruccio, President International of the digital asset manager Wave Financial. Matteo, thank you so much for joining us. Who's next? Is there a concern that it will take 5-6 more months, if not more, to work our way around this?
Well, thanks, Francine, for having me. And it's nice to hear someone pronounce my name correctly. Thank you. Yeah, I think, look, you know, I've been a pretty strong advocate for the fact that this is a young industry, and we're going to see, I think, more of this before it's over. But I don't think the terminology of nail in the coffin is the right way to look at this. I think this is a necessary phase for a young industry to go through in order to exit and emerge in a more healthy environment with a sort of a flight to quality. The better players, the more risk managed operators will end up taking over a lot of these distressed players, and I think we'll see a stronger industry emerge from all of this.
But Matteo, what needs to happen for that to be true? We're still seeing a lot of regulators and regulatory bodies not wanting to touch crypto until that's being taken care of. How can you be sure, where the end is, or at least where we're not going to see more bankruptcies or people going under?
Well, yeah, it's a great question, but I think we need to contextualize it and make sure that we remember this is today a $1 trillion industry. Despite all of the headwinds that we've seen, I don't know of many other industries that would survive so much onslaught as we've seen in the digital asset space. At the same time, I think we have a situation where we have the regulators now paying attention. My hope is that we'll see thoughtful and prudent regulation and not punitive regulation. That's always the risk. Obviously, as more of this plays out, we'll see what's behind the whole Genesis DCG situation. Let's see. But I'm really an optimist. I see more and more. I certainly here in Europe. I'm in Europe, and I see the regulators becoming much more proactive. We have the European community putting in place legislation. We see in MENA, Dubai in particular, leading the way, with Bahrain also putting in legislation. So I think with that regulatory clarity, I think that's going to bring a lot more institutional interest, because once institutionals know how this will be treated, how it'll be taxed, and considered from a legal perspective, there'll be a greater degree of eagerness to enter into this sector.
But Matteo, how big do you see the crypto crackdown, right, in the next 2 to 3 years? Again, there have been concerns, rightly or wrongly, about money laundering, about tax evasion, about fraud. Some of these concerns, is that what regulations need to tackle first?
Yeah, I think what makes this all a little bit uncharted territory is that as far as I'm aware, in my 35 years in investment management, I'm not really familiar with many financial innovations that started at the retail level and have worked their way up the, let's call it the financial food chain to the institutional. So I think, the regulators are very much focused on the retail end of this, ensuring that retail, and unfortunately, retail investors have been hurt in some of these things like the Genesis, and the Gemini Earn program and so on and so forth, Voyager and others, Celsius. But I think, I really do believe that the regulators will focus on that aspect of it, and I'm actually more bullish on seeing this develop into the institutional, what I call the individual, the wealth management space, where this is a very interesting market and segment and asset class, and I think all investors should and will eventually have a degree of exposure to digital assets.
Who, Matteo, do you think will survive this? And again, Genesis differed from a lot of the peers because they didn't market directly to individuals. It's almost like a fund of funds.
Yeah, I mean, that's a very, very good question.
It's a tough question.
Who will survive this?
Yeah.
I don't think we've seen, I'm reluctant to make any prognosis because we've seen things that we would never have expected to see. So that's it's a pretty difficult prognosis to make. I can tell you the type of players that will survive this will be the prudent, risk-managed entities, and I do see a flight to let's say a reawakening of the importance of experience, of knowledge, of risk management capabilities, and there's some of those more traditional skill sets that maybe perhaps in the past were undervalued in the digital asset space.
Okay, thank you so much, Matteo, for joining us. Matteo Dante Peruccio, President International of the digital asset manager Wave Financial, joining us this morning. Now, coming up, Bloomberg has also learned that an activist hedge fund has taken a big stake in Salesforce. So we'll bring you that scoop next. This is Bloomberg.
The innovation agenda is going full speed on mitigation. That's where, there's 100 companies, Breakthrough Energy's funded. There's
by mitigation, you mean mostly energy. You mean everything to do with energy. You mean generation of energy. You mean batteries. You mean transport. You mean all of the new, and there's some renewables that are already traditional, but more that need to come out. So that's the package that you're talking about, mitigation? Yeah. Or are you also talking about agriculture as mitigation?
Yeah, so every area of emissions, the world tends to focus on passenger cars and electricity. That's not a third of emissions. And so the focus on the easiest third, now 4% of new cars are electric, so that's the field that we're furthest along. About 4% of energy generation is wind and solar.
The moment news breaks, no one covers the world like Bloomberg.
In addition to him pleading not guilty, as we had expected, to 8 criminal counts here, there was a lot else that happened.
1 million people are getting infected every day, and that's going to rise to 3.7 million by January.
The UK is the only G7 economy that hasn't returned to its pre-pandemic level yet.
Bloomberg, your global business authority.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Countdown to the Close. Welcome to Bloomberg Crypto.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, we're just getting some breaking news from the Bundesbank chief. He is Mr. Nagel saying that the ECB will return inflation to the target without causing a recession. We have had a number of central bankers, including Klaas Knot, giving, of course, media interviews in Davos and then again yesterday. And we've also had the French line. So it's unclear at the moment whether they'll be quite aggressive in further rate hikes or whether they're very data dependent. But we'll watch euro dollar for the moment 109.17. Now, activist investor Elliott Management says it has made a substantial investment in software giant Salesforce. Bloomberg understands the stake is worth a multi-billion-dollar sum. The investor is known for seeking board representation and pushing for strategic changes. Well, joining us now is our Bloomberg technology reporter Aggie Cantrell. Aggie, great to speak to you. So what's the background to Elliott's stake? Why now?
So the background to it is essentially that Salesforce is one of the many parts of the tech sector that was really a pandemic darling. We saw the market cap go up to $300 billion in 2021, and now it's around half of that. So the question is Salesforce, while a company that has performed extremely well during the pandemic, how can it maintain that organic growth going forward? And even if it is still performing better than some of its competitors like SAP and Oracle, Elliott coming on board is probably more of a question of how to make sure that there is a good return on investment going forward for the company's investors.
So should Salesforce be worried? I mean, Elliott, I guess by reputation, is one of the most aggressive shareholders, activist shareholders.
Yes, so there has been worry over these sort of things in the past, especially when Elliott comes on board. But the difference is here is that we've already heard that he's very bullish on the CEO at Salesforce, sees him as a steady hand at the company. And that's going to be crucial going forward. We have seen 5 top executives leave Salesforce since September, including the co-CEO and the founder of Slack, who was brought on board when the company purchased Slack. And so what we're expecting to see going forward is potentially encouragement for potential share buybacks. And also, we are not likely to see Salesforce engage in any of these major acquisitions like they did with Slack a couple of years ago.
All right, Aggie, thank you so much. Our Bloomberg technology reporter, Aggie Cantrell, there in Berlin. Now, we'll have plenty more, of course, on this story throughout the day. Bloomberg Surveillance Early Edition continues in the next hour now. This is a picture overall, not only for technology, but for equities are seeing a little bit of a rise. Euro dollar, we just looked at it a couple of minutes ago on the back of the Bundesbank governor, the chief, saying that they will return inflation to target without causing a recession. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller and Kelly Lyons are in New York. Anna Edwards is here in London, and this is Bloomberg.
Somebody says, I want to be, and a person has an impact on society, what would you recommend that somebody do to train themselves and to work their way up to be somebody that's impactful on society?
Well, I think the first thing you've got to believe in something that you really care about. You know, I've been fortunate that over the course of my career, I've come up with things that have mattered to me, and I've pursued them. You know, the best advice I ever got was from Mike Bloomberg. And he said to me at one point, he said, show me somebody who's never lost, and I'll show you a loser. And I believe that if you believe in something, go after it, take risk. Obviously, they should be smart risks, but they should be around things that you really care about.
So you would see your legacy as being actually target ALS and helping to moderate the impact of ALS, if not curing it.
That's my final legacy. I'm proud of some of the other stuff that I've done as well. Transformation of New York after 9/11. I'm also incredibly proud of a lot of the companies we created at Sidewalk, but I feel like I've done a lot.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities
Could face bigger challenges next.
was going to keep rating World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
The direction, I think, is a good one. Inflation is still well above the Fed's target.
This battle, so to say, is not won yet. And I think central banks are probably right, and that has been our view, to warn markets not to get ahead of themselves.
We still have a considerable way to go to our 2% goal, and I expect to continue tightening policy past this meeting.
It looks like we'll have to be a little more patient to see if we're on the right trend.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Citadel's record-breaking year. Ken Griffin's hedge fund churned out $16 billion in profit for clients in 2022, the most ever. Elliott Management takes advantage of tough times at Salesforce. It's taken an activist stake at the company hit by job cuts and a plunging stock price. And more classified documents found at President Biden's home in Delaware. That comes after a 12-hour search by FBI agents. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And Kaylee, of course, many markets over in Asia closed for the Lunar New Year celebrations. Elsewhere, we are focused on central bank hikes, I suppose, on either side of the Atlantic, but celebration time in much of Asia.
Yeah, and for that reason, it was a really quiet day overnight. You had markets closed in China, Hong Kong, Taiwan, South Korea, and many others. So, Matt, I'm not going to do a check of the Asian markets today because really the only market that was trading was Japan. Stocks there were higher, but of course, we're going to get a little more action here in the U.S. today.
Yeah, well, hopefully. I mean, right now, there's a whole lot of nothing going on. S&P futures are unchanged right now. We had a pretty mega rally on Friday, up almost 2% on the S&P 500 in the cash trade. So maybe investors are waiting to see which direction the wind is blowing to kick off this week. It's the first long week in a few. We do have some moves in the 10-year yield, but very little there as well. 348 is the level here. Maybe the dollar I should have put in here because it's going to be interesting to see, as Anna mentioned, central bank moves, how that euro dollar moves, since the U.S. maybe is going to slow down its pace of rate hikes, and Europe maybe is going to keep going 50 if you listen to Klaus Knott. We're going to talk about that throughout the program. NYMEX crude right now at 81.88, so back up over $80 a barrel for West Texas Intermediate. We also see Brent climbing this morning. And then speaking of a climb, Bitcoin now up to almost $23,000, $22,782. So way back above the pre-FTX level, and seemingly not deterred by the Genesis bankruptcy. Bitcoin continues to rise. Anna, what do you see in Europe?
Yeah, some real resilience there in terms of the crypto story. This is what we see in Europe, a little bit of resilience in that we are making very modest gains across Europe, up 1/8% or so on the German market, on the UK market, really just trying to catch up with what we missed out on stateside, I suppose, during Friday's session. In terms of the focus, Matt mentioned what's happening with Klaus Knott and what he's been saying at the ECB, and that is really the heart of what's been driving things here in Europe. I can show you what's been going on with the euro dollar. We've seen euro strength, and in fact 4 days of euro strength, going above 109 for the first time since April, and we are above 109 still, so we've been sort of flirting with that line through much of this morning's session. But this after a number of hawkish voices last week were pointing in this direction and pushing back against earlier reporting that suggested that maybe there'd be some sort of dovish step down in the hike levels. So the euro responding to that hawkish commentary and up by 0.5%. Juventus, this is an Italian football club in the Serie A league over in Italy, and they have lost 15 points in their standings, and this is as a result of the way that they treat transfers, the accounting treatment of transfers. They've been found to have breached some rules there. They are appealing it. They deny any wrongdoing, but for the moment, it seems to have ruled them out of European championships, and that is having a negative impact on their share price. Symrise, this is German chemicals, and this is a business that reported some numbers after the close on Friday, and the margin looked to be light of what was expected, and so a bit of a clue perhaps to what's to come from some of the industrials here in Europe. That stock getting a negative reception, and natural gas prices really in focus. A real cold spell hitting Europe right now. The focus in the UK is very much on whether we're going to need coal resources switched back in. We seem to have avoided the need to do that over Monday night. Those resources had previously put on standby and now have been stood down. But the overall focus in Europe is very much on whether we'll continue to see this downward move in gas prices despite the cold weather, Kaylee.
Yeah, interesting to see the gas prices moving the way you would expect opposite now that cold weather has finally come for Europe in the UK. Now, let's turn to a big figure, $16 billion. That is how much Ken Griffin's Citadel made in a record year for profit for clients, the largest ever return for a hedge fund, and that was in 2022. Joining us now is Bloomberg Markets reporter Valerie Teitel. Valerie, how did Citadel pull this off?
Look, Kaylee, it's not about a single trader or a single trade, but it's really about this multi-strategy, multi-manager model that Citadel's running, which really consolidates all of these top traders under one fund, and each of these traders have their specific niche, their specific focus, and the risk management strategy that they run allows them to give capital to these funds that are doing well and pull capital back from these trading styles, from these managers who aren't doing well. Now, it's a dominant strategy in the industry now. It's about to take the baton away from these equity funds, which I say sarcastically struggled last year when the bull market finally came to an end. But you really cannot argue with the multi-manager success now. You know, Citadel not only returned such a sizable portion this year, but last year they also returned 26%, and that's on assets of $60 billion. That is something that a single manager is really unlikely to be able to raise that kind of capital under one single trading style.
So what does this mean? I mean, the rest of the hedge fund industry didn't really do this well, right? It was a losing year for hedge funds in general. What do we think about 2023?
Yeah, there's a lot of other hedge funds that did kind of struggle again in this equity bear market, but this really gives the key that there's going to be further consolidation within the hedge fund industry. It's been a big shift in the last 10 years, even in the last 20 years, away from these flashy single manager names all under one net. You have D.E. Shaw, Millennium, Citadel. They're really gaining a lot of weight in terms of the assets under management that they now run. And these multi-strats have really grown into such a sizable chunk of the hedge fund landscape. And that's one thing that's driven that is the overhead costs due to regulation of launching your own fund. Even if you have the capital, it takes a long time to start to trade. It's way more attractive just to join a multi-manager who already has all these back office, all these trading docs in place.
Okay, thanks very much, Valerie. Valerie Teitel, Bloomberg Markets reporter there with the latest on the hedge fund strategies. And Bloomberg has learned that the hedge fund Elliott Management has taken a multi-billion-dollar stake in software giant Salesforce. The investor is known for seeking board representation and pushing for strategic changes. Joining us for more is Bloomberg tech reporter Aggie Cantrell with the details. So what's the background then, Aggie, on Elliott's stake in Salesforce?
So we've seen Salesforce's valuation plummet since 2021 when the company bought Slack. We've seen that in recent weeks only, the company has said that it's going to have to slash 10% of its workforce, close office space. This is something that we've been seeing across the board for a lot of tech companies. And right now, what Elliott seems to be pursuing is a strategy of making sure that this company is on track for the sort of growth that it thinks it should be doing right now. And so essentially, we are expecting to see Elliott push for potentially similar changes that they've also been pushing for other tech companies that they've taken stakes in, like PayPal and Pinterest.
And given the example Elliott has already set with similar activist positions, should Salesforce be worried?
So when it comes to Salesforce being worried, I think the key point is that we've already seen that this company should be worried by the fact that it has lost 5 of its top executives since the fall of last year. And so now when it comes to Benioff himself, he's seen as quite a strong, steady hand at the company. But we could potentially see changes among the top executives. We could also see Salesforce is pushed to do share buybacks. And also the sort of acquisitions like they did back in 2021 with Slack are unlikely to still be on the cards.
Thanks very much for that. Agatha Cantrell reporting on tech for us out of Berlin. Now, the Justice Department in the U.S. has found more documents containing classified information at President Biden's home in Delaware. It was actually FBI agents searching the home for more than 12 hours. They are said to have found classified notes from the president's time in the Senate, as well as his vice presidency. Rosalind Matheson, Bloomberg senior executive editor for government, joins us now. So, Roz, we continue to hear about new troves of documents found. Is President Biden taking this seriously?
Well, that is the question. Of course, that one lot of documents is careless. 2, 3, now we're on document search number 4. And what this does, of course, as we see congressional probes start against the US president about this, is really remove any advantage that he had against the Republicans about this as we look forward to the 2024 election. Of course, now he's opened himself to attack from the Republicans, particularly Donald Trump, who says he's running for the Republican nomination in 2024. It's seen not just as careless, but downright sloppy by many people, including his own party, who are now out criticizing him, saying, heck, this is the last thing we need to be focusing on right now. We've got real issues in Congress, including with the debt limit, with government debt and so on, and we need to be focusing on that. And now we're going to get distracted by this further. And there's been a sense in some of the comments made by the US president that he's been a little bit cavalier about it, with that comment he made about his car in the garage, saying it was all right because it was locked up. Either way, these were classified documents that should not have been there in the first place.
Roz, good morning. So President Biden is also expected to name a new chief of staff today. What can you tell us about the appointment and its significance?
Well, actually, Joe Biden has been more robust and secure in his staffing, really, than former presidents who tend to cycle through their chiefs of staff quite a bit, even in their first term, let alone their second. So this guy's been around for 2 years, and that's actually a pretty decent stretch. And what we're seeing in terms of the names that are coming in terms of replacements for him, who might be running his campaign into 2024, is that we're seeing people who have already been in his orbit for many, many years. It's actually quite a consistent group around him. So they're sort of changing seats a bit, but not necessarily bringing in a whole lot of new blood. So it doesn't suggest disunity in his bench. It doesn't necessarily mean that there are problems. It's simply that he's gearing up to look at 2024, seeking re-election, a Congress now where there are key issues around the debt ceiling. You need experts on the economy to deal with that, how to wrangle that new Congress. And it's really about moving the chairs around to deal with that.
All right, Bloomberg's Rosalind Matheson, thank you so much. And we're going to have more on U.S. politics later this hour with Greg Valliere. He is Chief U.S. Policy Strategist at AGF Investments. First, though, let's get back to the markets and take a look at some stocks we are watching in pre-market trading this morning. I want to begin with Wayfair because this was a big mover in the Friday session. The stock rose 20% on the day after the company announced it was cutting 10% of its workforce. On Friday, you saw a number of analysts raising their price target on the stock, and this morning, JP Morgan upgrading it to overweight. So clearly, analysts really like the idea that this company is trying to rein in costs. As a result, Wayfair adding to the gains this morning, up more than 5% before the bell. Another company reportedly cutting jobs is Spotify. This was a Bloomberg report, according to people familiar with the matter. It is unknown the quantity of the eliminations that will be happening, but they could come as early as this week. So Spotify is up a little more than 1% before the bell. Two other stocks to mention as well. You have chip makers upgraded at Barclays, AMD, Advanced Micro Devices, and Qualcomm. The analyst saying he is more positive on semi companies that have data center, PC, and handset exposure. So both of those stocks moving almost 2% higher before the bell, Anna.
Okay, certainly part of our tech focus. Plenty more on tech to come this week, of course, Kaylee. Coming up on this program, Michael Metcalf joins us, State Street Global Head of Macro Strategy. What is he looking for from the earnings season still to come? We'll also focus on the hawkishness of ECB officials. That's certainly one of the headlines here in Europe. This is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. Earnings season is here.
Wall Street expecting a bit of an ugly season. People may be overly pessimistic.
We know growth is slowing.
Companies are going to have a lot of questions to answer.
Bloomberg breaks the numbers first.
Tons of banks coming out.
Some of the worst returns when it came to profit.
Markets really like that number.
With exclusive expert analysis.
What's your confidence in your outlook?
You got to be selective.
We still see a lot of opportunity.
There is a light at the end of the tunnel.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Welcome back to Bloomberg Surveillance. This is the early edition. I'm Matt Miller here in New York at Kaylee Lyons. Anna Edwards with us out of London. Now, if you're listening on Bloomberg Radio, because we are simulcast, you're going to miss a chart that is custom made. Dan Curtis put this together expressly for me this morning. So first of all, I'm honored and touched. Thank you very much, Dan. What it shows is what the market is expecting from the ECB through July, 146 basis points of hikes. The market's only expecting 51 basis points of hikes from the Fed. And because of that, you can see the euro has been on a steady climb here. The reason I love it, I think, is because it's so basic that even I can understand it. Let's bring in someone much more expert than me. Ven Ram joins us, Bloomberg cross-asset strategist. Ven, is this the reason that we see the euro gaining strength of the dollar? Simply the fact that markets expect the ECB to hike more than the Fed?
I think that is one of the crucial reasons definitely underpinning the euro's strength. We have seen in the past, since the start of the year, and even going back a few weeks earlier than that. Now, look, I mean, the ECB, as you were mentioning, is going to go 150 basis points from all indications, at least the ones that we got over the weekend, 150 basis points by the end of the summer. And the markets are pricing 46 basis points for the Fed. But I do think that they may go 75 basis points if they are going to stick to their dot plot guidance. So twice as much from the ECB as from the Fed. That's the takeaway. And what that means for real rates is that real rate differentials are going to narrow in favor of the euro against the dollar. And that is what is underpinning the euro's ascent.
Yes, and we've seen that euro ascent certainly today and over the past few days then, Ven. How high does it go? How high can the euro go on this particular theme? We're at 109 right now.
I think we are going to go to 114.30, and that's the call that I made at the start of the year with my year ahead outlook, 2023 outlook, MLive outlook for the year. That's the house call, 114.30. I do think that there is a bit of a scenario where it could overshoot. It could go to 115, 117 thereabouts, but I expect it to pull back to 114.30 ultimately.
Okay, Ven, if we could focus more on the dollar side of that pair, and frankly, the Federal Reserve, which it now looks like 25 basis points is going to be the move next week. If the Fed starts cowing to the market, what does that mean for their credibility in the longer-term fight against inflation?
Well, that's a great question, Kaylee. I mean, they didn't start off against this inflation fight very well. As you know, they kept saying transitory. And then they had a middle period when they did extremely well in terms of signaling to the markets what the intent is and getting there. Now we are getting into the tail end of the game, and now they seem to be vacillating a bit more again. We have heard from Hawker that they are going to go 25 basis points. Now, they've penciled in 525 as the top end of the range, according to the median dot plot that we got in December. Now, nothing really has changed for them to abandon that stance. So if you have penciled in 525, why do you want to drag your feet to get there? It makes sense to get there before the economy goes pear-shaped or wobbly at any rate. And therefore, I don't quite get this dragging of feet at the last minute.
Ven, what do you think happens once the Fed pauses? How long do they pause for? I heard some really different views today. One guest earlier on telling me that they pause and then they start cutting pretty quickly, and then others saying that's not going to happen, that we pause because elevated inflation levels will persist.
I don't think they're going to pause and cut immediately. I think there are two scenarios possible. Pause and stay there for a long time, or pause and take rates higher, if anything, because Fed, inflation is a lot stickier once it's entrenched, and it is deeply entrenched in the U.S. economy at the moment. Yes, it's been coming off. We have seen it come down to 6%, but 6% is not 2%. And getting to 2% is going to be a mighty difficult task. And if inflation stays around 5 to 6% thereabouts, the Fed is not going to be happy, especially in a scenario where we have got some soft landing.
Okay, still some tough stuff to do on inflation then, Ven. Thank you very much. Ven Ram of the Bloomberg Markets Live team. And for more market analysis, check out the Markets Live blog. MLIV Go is the function to use on your Bloomberg terminal. This is Bloomberg.
Seeds, typically between the time you start and they get out in the farmer's fields is about 8 years. Now we have a pipeline of innovations. We've been funding this CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets. China open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Do you think today it's easier for a black entrepreneur to start a company, or no more easy than it was 20 years ago or 30 years ago?
If it were easy, you would see more Bob Johnsons, more Michael Jordan, more Magic Johnsons, and Oprah Winfrey's and the like.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lines with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. In California, authorities say the suspect in the shooting deaths of at least 10 people at a Los Angeles area ballroom has killed himself. It's believed the suspect tried to carry out a second attack nearby. The killings during Lunar New Year celebrations set a wave of fear through Asian American communities. Meanwhile, China says more than 12,600 people died of COVID in the week before the Lunar New Year holiday. It's likely the real death toll was much higher given the scale of the outbreak. Meanwhile, a top Chinese health official suggested more than 1.1 billion people had been infected since virus controls were dismantled late last year. Poland will ask Germany's permission to send its German-made Leopard tanks to Ukraine. On Sunday, Germany's foreign minister said if Berlin were asked about the tanks, it would not stand in the way. The failure to work out an agreement on tanks has overshadowed pledges to send more military aid to Ukraine. And also, Germany and France are warning that European businesses will have to ramp up spending to compete with the U.S. and China. German Chancellor Olaf Scholz and French President Emmanuel Macron met in Paris on Sunday. They discussed how the EU should respond to President Biden's Inflation Reduction Act. That measure includes roughly $500 billion in spending and tax breaks to benefit U.S. companies. And Spotify is expected to be the next tech company to announce layoffs. Bloomberg's learned that the streaming music giant is planning layoffs as soon as this week. Spotify stock fell 66% last year as investors questioned whether they'd see returns from big investments in podcasting. So if you add Spotify to the list of tech companies that are laying off employees, Matt, they joined the ranks of Alphabet, Microsoft, Salesforce, Twitter, Meta, Amazon. It just keeps getting longer.
Yeah, there are a lot of companies laying off workers. We have a great Bloomberg opinion piece, actually, that shows it may not be the best idea, especially after companies have tried so hard to add workers. It could be bad for profitability going forward, Anna.
Yeah, indeed. How much is this Spotify story about the broader tech trend? How much of it is about the push into, as you mentioned, Kaylee, podcasting that they started in 2019? How much of it is about that structural shift and whether they're happy with that? Coming up, we'll get back to the macro stories. Michael Metcalf, State Street Global Head of Macro Strategy, will be joining the team. This is Bloomberg.
wrong, and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional assets monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and then it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Citadel's record-breaking year. Ken Griffin's hedge fund churned out $16 billion in profit for clients in 2022. That's the most ever. Elliott Investment Management takes advantage of tough times at Salesforce. It's taken an activist stake at the company, hit by job cuts and a plunging stock price. And more classified documents found at President Biden's home in Delaware. That comes after a 12-hour search by FBI agents. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. We'll have more on the politics a little bit later on in the program, Matt. But in terms of the markets, expectations for stocks fading a little as we head towards the open.
Yeah, we have seen futures in the U.S. come down a little bit since the start of the show. We were unchanged about 30 minutes ago, and right now we're looking at a drop of about 0.2% on futures. Of course, this is after the big gains that we had, almost 2% on the S&P 500 in the cash trade on Friday, getting closer to that 4,000 level. Not a lot of movement in terms of the 10-year yields either. Right now, about 1.5 basis points to 349.33, I should say. So holding steady at that level. NYMEX crude also holding fairly steady, but back up above the $80 level for West Texas Intermediate. 82.05 a barrel is the level there. And then Bitcoin continues to rise, approaching 23,000 right now. We're at 22,923. So not deterred by the bankruptcy at Genesis and back above the level that we saw before the crash of FTX. Kaylee, what do you see in terms of the pre-market movers?
Well, I want to pick up on a story that Anna mentioned, which is Elliott taking a multi-billion-dollar activist stake in Salesforce. Salesforce in pre-market trading is up about 3.4% as a result. The idea being that perhaps Elliott is going to push for even more cost cutting and also potentially more share buybacks. Now, other stocks moving higher include a lot of the chip makers. So you have Marvell Technology, which is in the chip space, up about 0.8%, and AMD and Qualcomm each moving higher to the tune of about 2% after they both got upgraded at Barclays. The analyst over there preferring chip stocks that are having exposure to data center, PC, and handset markets. So those two stocks moving together before the bell, Anna.
Kaylee, let's have a look at the European equity market space then, and we're pretty flat actually. So as we see US equities fade in terms of the futures picture that Matt just went through, we've got European stocks not going anywhere in a hurry really. We are flat here. This is one underperformer. This is a German chemicals business, Symrise. I picked it out because chemicals is one of the worst performing sectors across the European equity space today. And this stock down by 6%, reporting numbers on Friday after the bell, which showed that the margin was not quite what analysts had been anticipating, and as a result, the stock is being sold. This is the central bank conversation of the moment. moment, really, and here in Europe, certainly, and this is around the ECB and how many more outsized hikes will we get from the ECB. Klaus Knot of the Dutch Central Bank is saying that he thinks at least another 50 basis points will be needed, 50 basis point hikes will be needed. As a result, that's an ongoing pushback against any dovish rhetoric that was in the markets the early part of last week, and so we continue to see the euro gain, and it has gone above 109 for the first time since April, so we'll watch that one. And a lot of the brighter outlook for Europe that is enabling this conversation and this more hawkish rhetoric to come through is to do with what's been going on with, well, the weather. It was milder than expected through much of the winter, and indeed what's been going on with gas prices. So we do have a 63 euros a megawatt hour gas price here in Europe on the European benchmark. It is continuing to fall despite the fact we've gone into a warmer period. It's way below the 340 or so euros a megawatt hour that we had at the height of the crisis in the middle of the summer then, Kaylee, but it is a little bit higher than it was in the mid-50s range around the middle of this month.
Yeah, and perhaps that is just adding fuel, if you will, to the ECB's kind of hawkish narrative. They will continue, they say, to have these outsized rate hikes, unlike the Federal Reserve, with official after official now playing up the idea of 25 at their meeting next week. So joining us now to discuss is Michael Metcalf. He is head of macro strategy at State Street Global Markets. Michael, thank you so much for being here. So we know that the journey may look a little bit less pronounced in terms of the ultimate size of each rate hike at each individual meeting. It is about the destination and, frankly, how long the Fed stays at terminal. Is the market misplacing its optimism if the hikes are smaller, but we still could ultimately stay up there for longer?
Yeah, look, I think that's the big question for 23 so far, is that the market's getting quite excited about the idea that rates go up more slowly, and that means that they then come down quite quickly. And I do worry that the rate cuts priced for the end of this year need a very different set of data than the ones that we're currently getting.
And good morning to you, Michael. And here in Europe, the conversation is also very interesting and slightly different in that we are not talking about that step down yet, or at least the ECB doesn't want us to be talking about any step down from 50 to 25. The message coming loud and clear is that staying the course, as we heard from Christine Lagarde, with these larger hikes as underlined by the Dutch Central Bank.
Yeah, and I think right now central banks are having a bit of a battle with market pricing, and that's particularly true in Europe. But of course, you have to remember that European rates are lower, and the ECB has been playing catch up against the inflation trend really until December. And it was only at that December meeting when they revised their forecast, it was like, actually, now we're worried, you're going to have to listen to us. And I think it's going to take a while for the market to adjust.
And of course, as the European economy gets stronger, and it seems to be stronger than a lot of people had expected through the winter, does that just mean more hiking? We go higher, the terminal rate is pushed out further.
Well, I mean, just as you said in your intro, things like the weather all play into this. I love the line, it's fuel for ECB hawkishness. I mean, it absolutely is. And I think given where their forecasts were in December and the data we've seen since then, the ECB has no option but to remain very hawkish, even though the market seems to be leaning towards a more dovish outcome.
What's your view on the chances of a recession, or how deep a recession we have, Michael? It seems that until last week, we were getting more and more optimistic in our outlook.
Yeah, I mean, I think we've always had the line that a recession was probably a slightly lower probability than some of the market pricing and some of the economists' forecasts. I actually think that the last set of industrial production data in the US did make us actually begin to hesitate on that. But I think the one thing that we can be confident of, particularly in the US, is that if there is a recession, it's going to be very mild, because balance sheets of corporates and in particular consumers are in such good shape. It's almost like the recession will be the opposite of what we had after the GFC, which was a balance sheet driven recession. Here, the balance sheets are in such a good place that the recession is likely to be mild.
It's, a lot of people had become meteorologists, much like we were virologists a couple of years ago, as the weather got warmer in Europe. I hear it's particularly cold right now in London. Is there any chance that that causes havoc again?
Well, so we've sort of been joking as to whether we can forecast financial markets better than we can forecast the weather. And, after the 12 months that we've had, I'll be frank, we're not quite sure, but I can tell you it's very cold right now. And look, I think given the optimism that we've had to start the year, which is great, we didn't have much optimism last year, I think the weather is just one of the uncertainties that we need to play into alongside, the kind of the stubbornness, if you like, of central banks.
Well, and be it because of the weather or other factors, we have seen Europe outperforming the U.S. this year, but there's this kind of growing narrative that maybe we've already seen the gains of the year and that there isn't much more upside from here. What is your outlook on the equity market, both in Europe and the U.S. in particular?
Yeah, I mean, look, I think you have to be careful about how, I think there's a big difference between people's expectations and investors' positions. And so I think, look, everyone's been very downbeat on Europe for a long time. Investors are underweight, it's undervalued. And that isn't going to change overnight. So I think even though we've had a good run recently because maybe people were overly pessimistic on Europe, I wouldn't then flip it to say actually now investors are overweight Europe and there's too much priced in. So I think it takes a while for positions to adjust, even though the kind of the consensus market narrative is that things have gone very well.
And I know it's a Lunar New Year holiday in many parts of Asia, so maybe we're forgiven for not having introduced that theme into the conversation up to this point, Michael. But if you look at actually where profit upgrades are coming from, they're coming fast from Asia, and all of this to do with the China reopening story. How do you factor in that China optimism into your narrative?
Well, so I think the one thing I would say, we talked about Europe being under-owned and undervalued. That's true for emerging markets and APAC in particular. Times a factor of it's a multiple. So I think actually right now if we're concerned about the ECB being a bit more hawkish, the risks of the weather, right now actually APAC and EM in particular might be a better reflation play right now.
Okay, Michael, thank you very much. Michael Metcalf of State Street with us to talk global markets. Coming up on the program, more classified documents found at President Biden's home. We'll get back to U.S. politics. We'll discuss with Greg Valliere, AGF Investments Chief U.S. Policy Strategist. This is Bloomberg.
Top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. We're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lyons here in New York. Anna Edwards with us out of London. Now, the Justice Department has found more classified documents at President Biden's home in Delaware. Actually, it was the FBI that found them in a search lasting more than 12 hours, turning up classified notes from the president's time in the Senate as well as his vice presidency. And the latest discovery escalates Biden's legal and political predicaments ahead of an expected 2024 re-election campaign. Joining us now for more is Greg Valliere, Chief U.S. Policy Strategist at AGF Investments. So, Greg, how serious is this? Is it a real problem for President Biden, or is it just typical that old politicians take classified documents home with them?
No, I think, Matt, this has gone from an annoyance to a really serious crisis. And it's not, ironically, the documents. It's this. These documents were first found on November 2nd. The midterm election was about a week later. Who gave the order to not publicize this, to not go to the National Archives? I mean, somebody delayed disclosing this by a week, and there's a lot of speculation about who that might have been.
So what does this mean for then the president's 2024 bid? I mean, will people in his own party even push him out?
Well, it had been a poorly kept secret that a lot of Democrats were lukewarm at best about a second term for him. As everyone points out, if he served a second term, he'd be leaving the White House at the age of 86. I mean, he got a lot done. I don't think there's a lot more that he'll have on his agenda. He's got a big fight coming up with the debt ceiling. And I think it's possible that he may decide to drop out. The better chance is that he will stay on the ticket. But I also think it's possible there may be a Democrat or two who might be thinking about challenging him in the primaries.
Well, and we know, Greg, that both the Democrats and Republicans are fractious parties at the moment. You have the hard left and the hard right, centrists in the middle. I mean, is there realistically another candidate that could unite the party?
You know what I think would unite the party, Kaylee, would be a fresh face. I think more and more Americans are looking for somebody other than Joe Biden or Donald Trump. I mean, the Republicans are moving there more quickly. In the last few days, it's clear that Nikki Haley's going to run. Obviously, Ron DeSantis is going to run. There are several other Republicans like Mike Pompeo who might run. On the Democrat side, it's just Joe Biden, who's 80. And I think the Democrats have to be thinking that a fresh face has some real advantages.
All right, and Greg, if we could look a little more near term now, before 2024, we need to get through June and raise the debt ceiling so that the U.S. does not default on its debt, especially as we're talking about fractious parties and Republican hardliners who we have seen have the ability to disrupt the course of the normal democratic process. Is there a greater risk, really, that the U.S. could get closer to the edge of the cliff this time or potentially even take a step off?
Yeah, I don't think a step off, but I think we're going to get very close to the precipice. Very important statement made last week by Mitch McConnell, who has a lot of clout in the Senate. McConnell said, we are not going to default. I thought that was significant. It's going to be difficult in the House. Kevin McCarthy might wind up losing his job, but I think in the end, it'll get done at the very last moment.
Yes, I wonder what is the role of McCarthy, given the precariousness of his position, Greg?
Well, he's obviously a fairly moderate Republican, and he has priorities like defense spending, like aid to Ukraine. There are things that he feels have to get done, and he, I think, takes seriously the U.S. pledge to honor our commitments. So I think McCarthy will be a big player. The Senate won't be the problem. Again, it'll be the House.
What kind of arguments do you think will bring round those Republicans who really want to take this to the edge and test the financial markets on the debt ceiling? Are there any arguments that can be used, like the ones you've just put out that we've heard from McConnell and others, that would persuade them to take any different kind of tack here?
Yeah, I think there'll be a lot of adults in the room, not just McConnell. I think that Jerome Powell may get very vocal in saying this is crazy, we can't do that. I think the Republicans in the House have to look at the polls, and I would guess that by midsummer the polls are going to show the American public feels this is madness, and especially if there's a growing fear that going off the cliff could hurt the economy.
It does seem that we have this every once in a while, and I recall distinctly, Greg, the last time we had a ratings downgrade, investors flocked to treasuries, so it didn't hurt the economy.
That's right. And there's one other common theme in all of these near misses that we've had, and that is that things wind up more fiscally hawkish, more restrained. And I think whatever deal there'll be, and there's going to have to be a deal, I think will cut back on spending, which has been the pattern of these fights in the past.
How do these things usually play out in the court of public opinion, Greg? I mean, would edging close to the precipice of default play out worse for Republicans if they're the one holding up raising it, or is it ultimately the president who feels it?
Usually the Republicans lose the PR battle. They have a long history of self-inflicted wounds on this subject, and I think it will happen again. But in order to get to a public backlash, you probably have to have a very volatile market. And I think volatile markets are going to be a feature of 2023.
Okay, so we might see that then. Greg, thank you very much. Greg Valliere, Chief U.S. Policy Strategist at AGF Investments, with thoughts on U.S. politics. Coming up on Balance of Power, sticking with the political theme, former U.S. Ambassador to NATO, Kay Bailey Hutchison. That's at 12 p.m. in New York, 5 p.m. in London. This is Bloomberg.
Stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
The top names in business are on Bloomberg.
Different countries are at very different places, so you actually cannot speak in generalities. We expect to see a rolling series of country recessions, but the vulnerabilities that amplified previous recessions around the world are not present. That omens well for a mild recessions when they come.
Nobody covers business like Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Now let's take a look at what's coming up for the rest of this week. Tomorrow, we'll get earnings from Microsoft. Consensus sees second quarter revenue growing at the slowest pace in 6 years. And of course, the tech giant recently announced another wave of job cuts. Then on Wednesday, more big tech reporting. Tesla will be giving its fourth quarter results after the closing bell, after recently announcing price cuts across many of its markets. Then on Thursday, a lot of eco data out of the U.S., including GDP and retail inventories. Plus, the energy branch of the French Union also starts a 48-hour strike on Thursday in opposition to President Emmanuel Macron's controversial pension reforms, Matt.
All right, we'll continue to watch what's going on there. And speaking of the French, over the weekend, the President Emmanuel Macron, as well as German Chancellor Olaf Scholz, met in Paris, continuing the push back against the U.S. Inflation Reduction Act.
It is necessary that we handle the inflation reduction aid and formulate a European answer. Firstly, we have to make sure that, as a European Union, we are not treated worse than neighboring countries such as Canada or Mexico. And it cannot be accepted that the many local content regulations that are in there cause discrimination of European businesses and their activities in the U.S.
Unternehmen bei ihren Tätigkeiten, Aktivitäten in den USA bedeuten.
Joining us now is Bloomberg's Western Europe government editor, Richard Bravo. So, Richard, why are European leaders so worried about the U.S. Inflation Reduction Act? Do they not think that the U.S. is really going to come to the table and change things?
Hi, Matt. Yeah, so I mean, it's important to keep in mind that the point of the IRA is to help the U.S. finance the green transition. And broadly speaking, this is a concept that Europeans support wholeheartedly. What they argue with is that they feel that the way the law has been created unfairly subsidizes American companies. And as a result, European companies will be at a structural disadvantage, and they won't be able to compete with their American counterparts. They also feel that because the U.S. is giving so many subsidies to American companies, it will actually entice European companies to relocate to the U.S. from Europe. And this is obviously something that has caused quite a lot of concern on the continent.
Yes. So whilst European leaders might want to see more investments in green technology, they don't want to necessarily be excluded from that, and they don't want anything that looks like protectionism. Another issue that was discussed by European leaders a lot last week, and will be no doubt discussed at the European foreign ministers meeting today where you are, Richard, is around the supply of tanks, either by Germany or Germany allowing others to supply tanks to Ukraine. Where have we got to on that?
So this is a very complicated issue, and it's basically started because Ukraine has asked for the supply of heavy battle tanks, especially before the spring when many people expect there to be a new offensive. Now, Germany has a heavy battle tank called the Leopard, and in order for other countries to re-export their stock of Leopards to Ukraine, Germany has to give approval, since all these tanks were made in Germany. And Chancellor Olaf Scholz won't do this, and there are a few different reasons why he doesn't want to give this okay. Partially, he doesn't want to escalate things with Putin. He also says he wants to build a coalition of countries to come on board and do this as more of a joint venture. But criticism is mounting among countries. Poland has been very vociferous in calling for Germany to greenlight the supply of these tanks to Ukraine, as has Estonia. And the U.S. has also called for Germany to allow these tanks to be sent to Ukraine.
Richard, thanks very much. Bloomberg's Richard Bravo in Brussels, continuing to monitor that story. And it's one we'll continue to watch then, Matt, as it seems that various voices within Europe giving slightly different messages about this at the moment as to whether Germany will stand in the way of other European countries if they want to give their tanks.
Yeah, it's really interesting to see Germany blocking this. Of course, they have a history of being, well, you know, since the Second World War, against these kinds of, against any kind of violence and pushing for peace. But they also have a history of supporting Russia, and that's what paints them really, I think, in a bad light, since they've been so reliant on Russian gas.
We will focus back on the markets in the next hour, though. This is it for Early Edition. Surveillance is ahead with Tom, John, and Lisa. They'll be hearing from Margie Patel of Allspring Global Investments, among other voices. Plenty more still to come on the markets. This is Bloomberg.
institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live, and it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Countdown to the Close.
Welcome to Bloomberg Crypto.
We have a Fed here who's not backing down.
What is the market saying? I don't believe you. It's it's pricing in rate cuts. It's already seeing the data roll over.
The way they're feeling now is comfortable that they've maybe done enough or getting close to having done enough.
At some point, you have to move to 25 because you've done a lot. You don't know how much damage that you've done.
Expectations for the remainder of the year for 2023 are quite bleak. Earnings are supposed to go down.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. This is Bloomberg Surveillance. Jonathan Farrow in London. Lisa Abramowitz back from the Alps, and I'm Tom Keene. I don't have a life. I did absolutely nothing, unlike London and the Alps. We welcome all of you. John Farrow with us here, coming up on foreign exchange, an important discussion with Jeremy Stretch, and we say, welcome back from Happy Valley.
Thanks. It was kind of happy, actually.
Were you the gloomiest person in the Valley?
You know, no, because there were some people who, under the breath, said that they did expect things to turn. What I thought was interesting was the divergence between the economy versus markets. People more optimistic on the economy, markets not so clear, and that's where the divergence really seems to be.
Well, we get started on a week here of economics, finance, investment, lots and lots to talk about, but let's link it into maybe the key statistic, and I think a surprise for our viewers and listeners, Lisa, and that is simply Q4 GDP, first look, 2.7%. I guess that's a recession.
Yeah, well, this to me is the compelling aspect.
Do people know this?
Well, look, how much do we end up with some sort of recession? How much do we end up with a better than expected outlook, right? Which is really what a lot of people are expecting because people still kept going out and spending, and we are seeing weakness, but it isn't really coming through in force. But really, this goes back to this idea of profit margins being crimped. Morgan Stanley, the House had two reports over the weekend. One, from the economics perspective, we could get a soft landing. From a markets perspective, Mike Wilson, we're still going to get that drop off in earnings, and we're going to see it in this quarter.
Yeah, well, it's interesting. I thought you know, and John, if he was here, we'd talk to him about it, but he's in London. And what I love about him, Mike Wilson, is he's waiting for the last stage of a bear market. He's not saying it's here now, but he says you need that, and we're not there yet.
Companies aren't going to lay off workers as quickly as many people had in the past because they know what happens. You can't hire them again. They also want to remain competitive, so they're not going to necessarily raise prices as much. You're not seeing the same kind of margins as you did last year. So so earnings could go down even as the economy kind of muddles through.
Well, that's going to fold into the economic data of the week. It's an important week of economic data here to the February 1st Fed meeting. I mentioned the GDP statistics. There's some S&P PMI numbers, and John believes in. I'm looking at retail inventories is an interesting dynamic. Claims, while you were gone, we had a 190 print on claims.
I know, I saw that.
Shocking.
It was shocking. Wasn't the labor market supposed to weaken? At the same time, there are a number of reports coming out. It's taking longer to really get a new job. It's taking longer for companies to decide to hire people. So softness around the edges.
Framing on a Monday here on a full work week, 5-day work week, something odd. Let's look at the equity markets here. -5, Dow futures -12. The VIX really doing nothing, 20.27. Dollar weaker again. John Farrell coming up with Jeremy Stretch of CIBC. 2-10 spread, real yield not giving me much love this morning. And Lisa, an elephant in the room, climbing up. Brent crude 88.20.
The highest going back to November. And this, to me, is one of the most interesting elephants in the room. When does the inflationary element of the reopening of China start to bite in a more material way in the expectation of a happy landing, of a happy existence that a lot of people are putting out there? I do want to give you a sense. Today's kind of a slow day, and this is the quiet period for the Fed ahead of their next meeting.
We wanted to ease back into it.
So I wanted to give you a sense of what we're looking. No, it's not auction free. This week, there are 3 auctions, and I'm most interested in the 5-year. So there's a 2-year, $42 billion of 2-year notes being auctioned off tomorrow, $43 billion of 5-year notes on Wednesday, $35 billion of 7-year notes on Thursday. 5-year yields is where I'm interested. How much do people buy this story that the Fed, the ECB, can get inflation under control? They're pledging to. How much are they going to pull their foot off the brake a little bit sooner than people expected? This week, earnings. Tons of them. We get Southwest, we get American, IBM, credit card providers, American Express, Visa, and MasterCard. But the ones I'm watching, Microsoft tomorrow, Tesla Wednesday, and Intel on Thursday. Those are the most interesting to me.
And this is important. Coming up later on the program, Daniel Ives of Wedbush here. It could be a 2-hour interview. I want to focus on Apple as the one company left standing in the layoff derby. What do you want to talk to Dan Ives about?
Whether they can still be the leadership, because that seems to be the message from the returns that we've had this year. Also, just want to say that Friday, 8:30 a.m., we get personal and income and spending. At 10 a.m., we get University of Michigan sentiment survey for January. Core PCE. How much is core inflation, the measure that the Fed looks at? How much is that coming in?
We get core PCE this week?
Yeah.
I did not know that.
Well, you know.
There's your brief. Lisa Bramowitz back from Davos. We'll talk much more about lessons learned from the World Economic Forum meetings. One thing we know is a lesson learned is to listen to Margie Patel. She's at Allspring Global Investments. And what is so important about her decades of work is the fearlessness to mix from fixed income to equity. Margie, what is your weighting, your relative dynamic of fixed income versus equity?
We're geared over on the equity side. We have been actually, even with the Fed increasing rates last year, the reason being rates were so low, we felt that there was just a potential to lose money on the bond side as on the equity side, and that really played out. And this year we see rates have come down quite a bit. So again, we think bonds are an okay bargain, but really nothing exceptional, particularly when we think we see better opportunities on stocks.
How does the angst, and particularly the tech angst, which is being underplayed over the weekend, I get that. How does that play into your core framework of dividend growth or use of cash?
I do think that we're going to see more of an emphasis on dividend growth and higher than average dividends for stocks that do well, particularly because we still have a lot of high PE stocks who need to have their PEs deflated, especially if we see lower earnings, which I think is a general consensus.
Well, but Margie, just to go back to what Tom was talking about with tech, will tech still lead in whatever rally we see in equities that you're expecting?
I think tech will lead certain sectors. I think the semiconductor sector will lead, although we may have to wait for mid-year to see more clarity about increasing demand. And also because the prices of those stocks are rather reasonable, the dividends are rather reasonable. We still think the high PE tech stocks may have some underperformance this year.
So are you basically rallying around the idea of these job cuts? Are they positive to you? Is this the washout, the cost cutting that you've been looking for? Or is this just a story that perhaps has been given up too quickly? Is there a distinction between the haves and the have-nots right now that you're highlighting in terms of what you're buying and what you're not?
Well, I think as far as job cuts, the market has generally regarded that as very good for earnings, but it telegraphs what those companies think their business outlook is. You don't lay off 10 or 12,000 people because you think you'll see a spring back at the end of this quarter. So that says to me companies looking at their business are looking to be more cautious.
So when you say that you don't like bonds and you like equities, What is it about bonds that you don't like? Is it that basically you think that people aren't pricing in the rate hikes? Is it that you basically just don't think that they're going to have the same kind of return profile? Or is it just that equities offer more in an early cycle kind of feel, which some people believe we're entering into or will by the end of the year?
Yes, I think you have to be early for equities because you'll never really catch the bottom. But really, if you look at investment grade, say A-rated, you're looking at, say, 2.25%, 3.25% for 5 to 10 year maturities. Those aren't yields that you can really say I can make a lot of money in. And even high yield double Bs are more around 6.5%, say 8.5% for single Bs with maybe 5 to 10 point discount. That's modestly attractive, but if those do well, equities have to do even better.
Margie, over the weekend, I saw a massive effort to find some analog back to the Boston Tea Party over where we are right now. What's the analog you use in terms of saying 22, 23, and dare I guess 24 is like what? What's it like?
Well, it's not like anything because we never had a period of multi-year near zero rates and a deficit that's so extremely high at a time when the economy did okay. So I think that's what's different. I think people are banking too much on the Fed being more modest, a 25 basis point increase, and that will somehow cause the no recession to occur. So I think people are being too optimistic about that and not maybe cautious enough on what the damage is being done to the real economy that we're seeing in those early statistics that Lisa was talking about.
Tom, the Tea Party, what's the analog for that?
The Tea Party is the analog. It's the last time the Red Sox had a shortstop. Margie, one more question, if I could. On Friday, as an exercise, I looked at my bond portfolio. My long duration Austria, 97 years, taken a bit of a loss. But I think it's unknown how much investment grade quality corporates are down, down, down. Is it the mother of all times to buy quality investment grade corporates?
Well, I think that they're really rather modest. Actually, the investment grade and high yield have done about equal to the equity averages, Dow and Standard & Poor's. And I think, as I said, the returns are rather modest. And I think that there's still some uncertainty about will we see rates actually begin to taper down or will we see rates actually go up if we have higher defaults or much slower economy. So I don't see a tremendous opportunity in bonds at this point.
Margie Patel, thank you so much. I just want to say, folks, to give you a wisdom into the Boston market. Margie Patel was a young kid, and there was a triangle of fixed income excellence. Daniel Fuss, Felix Smith, and a young whippersnapper, Margie Patel, that made it the best fixed income block in the world. Margie Patel now with Allspring giving us wisdom there. What'd you learn there? I mean, with her experience, she's over in equity land.
What I think is fascinating is exactly that. She's 75% in equities, I believe, or something like that, even though her training really is in the bond space. What she said there, if bonds are going to do well, stocks are going to do even better. So why not just go stocks?
Well, that's a core thing here, but what I see is against a consensus call. But even while you were gone up Happy Valley, the basic idea here is everybody's on board bonds. All my radar's up.
I would agree with that, especially if you still have inflation and you still have central banks that are committed to doing something that potentially could be a lot. Did you know investment grade and high yield both gained about 3.5% in the first 3 weeks? It's the same as the S&P.
But did they give back in the last couple of days? I mean, high yield's like a rock, right?
Yeah, a little bit, but not that much. And what you can see is that people are still going in because they want the coupon and they see that on a relative basis to the past 10 years, you're actually still getting yield.
On a Monday, get ready for Fed meeting, February 1. We're getting ready for that right now. Our team is working on a stellar group of the usual suspects. Looking forward to that. And we do that with a very busy week of economic data and conversation to drive forward. Dan Ives scheduled to be with us here with Wedbush and Jeremy Stretch with our John Farrow in London in a bit. Futures a little bit of a loss, -7. The VIX 20.20. Yields can't get out of their way, 3.50% in the 10-year. 2-year, we're on that 3.99 watch. Forget about it. Backs up to 4.18%. Stay with us from London, from New York. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo.
In California, authorities are trying to figure out the motive for a mass shooting in an Asian community near Los Angeles. 10 people were killed when a gunman opened fire in a ballroom during Lunar New Year celebrations. The suspect, described as an Asian male, was found dead of a self-inflicted gunshot wound. Poland will ask Germany permission to send its German-made Leopard tanks to Ukraine. On Sunday, Germany's foreign minister said if Berlin were asked about the tanks, it wouldn't stand in the way. The failure to work out an agreement on tanks has overshadowed pledges to send more military aid to Ukraine. China says more than 12,600 people died of COVID in the week before Lunar New Year holiday. It's likely the real death toll was much higher given the scale of the outbreak. Meanwhile, a top Chinese health official suggested more than 1.1 billion people had been affected since virus controls were dismantled late last year. The Justice Department has found more documents containing classified information at President Biden's home in Delaware. FBI agents searched the home for more than 12 hours. They're said to have found classified notes from the president's time in the Senate and vice presidency. Ken Griffin's Citadel made a record $16 billion in profit from clients last year, the largest annual return from a hedge fund manager. Now, it also surpassed the amount John Paulson generated in 2007 on his bet against subprime mortgages. Estimates from LCH Investments showed the top 20 hedge funds turned out $22.4 billion in profit after fees, but losses grew outside the industry giants. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power. This is Bloomberg. Earnings season is here.
Wall Street expecting a bit of an ugly season. People may be overly pessimistic.
We know growth is slowing.
Companies are going to have a lot of questions to answer.
Bloomberg breaks the numbers first.
Tons of banks coming out.
Some of the worst returns when it came to profit.
Markets really like that number.
With exclusive expert analysis.
What's your confidence in your outlook?
You got to be selective.
We still see a lot of opportunity.
There is a light at the end of the tunnel.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
One side thinks that the other one's more responsible for the debt at $31.4 trillion. That is totally not accurate, and it's deceptive. We're all responsible. We got a $31.4 trillion debt. It's a runaway debt, and no one's holding themselves accountable. If you're going to use a debt ceiling for anything except for theatrics, okay, which is what probably might happen for a while, we're going to pass the debt ceiling. You are exactly correct. Right. It has to pass.
The gentleman from West Virginia, Mr. Manchin, on Meet the Press on NBC. It was good to catch up with him there. Thank you to many of the Sunday talk shows for their efforts on Bloomberg Radio. It's hugely popular, a Sunday redo there on Bloomberg Radio. And part of it is, well, getting together or not. And of course, Senator Manchin of West Virginia deep in that. Lisa, let's first go to something that I really think over the weekend was there, which is the trade idea that if we're not going to trade with China, who are we going to trade with? And Neil Shearing has a very thoughtful note out at Capital Economics talking about, is the next China Mexico, Vietnam, and in Eastern Europe, Poland as well. Shearing leaning there on the Davos trend of what's the next globalization look like. What did it look like in Davos?
China, that's what it looked like. Hard, absolutely full stop. And that's what I thought was most interesting. There are companies so hinged to China, they cannot afford to move away from it.
They can't go to Vietnam.
You've got auto manufacturers that, well, it's not just with respect to manufacturing, but it's also with respect to selling. And it's with respect to the political environment where if you don't manufacture, you can't sell there. And so it's really hard to see how it really diverges the West and the East in the same kind of way that people are talking politically when the business environment is quite different.
You and I know that there's early Davos folks, middle Davos, and late Davos, usually centered around the piano bar. But forget about that. China, what a splash at early Davos this year. Did that carry forward through Wednesday, Thursday, Friday?
That was the entirety of a lot of the conversations. They had a lunch with Liu He, the vice premier of China, with a number of the manufacturers, in particular the chip makers, to understand the backdrop of that. So there was very much a presence there, and there was very much a willingness to do business, which again raises a question of how does this bifurcation really come about?
I'm guessing Taiwan wasn't invited. Right now, we'll go to Washington, where she's always invited. Anne-Marie Horton joins us now, our Bloomberg Washington correspondent. We've been talking up on surveillance, Anne-Marie, the typical, usual changing of the guard. Klain to Zients as chief of staff to the president. Let's begin with Civics 101. What does the chief of staff do?
This is really the top managerial role in the White House, and this is the individual that is the gatekeeper to the president, in charge of the schedule, in charge of who gets access to the president. So it's really a critical role. Also, part of that is going to be obviously outreach with Congress. So this is a really important critical role that has a lot to do with the ebb and flow of how the West Wing works.
I'll let Lisa go forward. Let me go back. Was Klain successful?
Many would say Klain was successful in the sense that look at the president's legislative priorities and what he was able to get through Congress. Worked in a bipartisan way to get hard infrastructure done, and at the end of the day, they got their Build Back Better in a mini form done in the Inflation Reduction Act. And he also was able to make sure the president was on board, or really helping to get the president, helping the president get the rest of Europe and Western allies on board when it came to, obviously, Russia's invasion of Ukraine. So I think many would view him as being a successful chief of staff, even if they don't agree with his politics.
Anne-Marie, you mentioned a lot internationally, and that's really where I wonder where Jeff Zients comes into play, his new chief of staff, considering his lack of experience internationally. How are people concerned this plays into just the discussion we were having, trade with China?
I'm not sure people are concerned by anything with Zients in terms of international experience. This is someone who served on corporate boards like Facebook. He has deep managerial experience. He was a consultant. He was a founder of an investment firm. And anyone you talk to, and I've talked to a number of people this weekend, say that this is someone who he's known as Mr. Fix-It. He's able to get things done. So that's why a number of individuals are excited about his appointment, thinking that he could be a good person to be that gatekeeper to the president. Also, they're really about to get ready for a fight with the Republicans when it comes to the debt ceiling. And under the Obama administration, he was the head of the NEC, the National Economic Council. So they think this is someone that's well prepared for that domestic fight.
Although you do talk a little bit about some of the issues and his board service on Meta, among others. How much does this indicate that the Biden administration is pulling back from some of the discussion about going hard against some of the big tech names?
I'm not sure that people are thinking that because Zients is now the chief of staff that this means that they'll have a different view on tech, right? He left that board because he didn't agree with the direction of where that tech company was going. So potentially some may think that he has a special inside view.
Right.
I think when it comes to this individual, what Republicans probably will most likely say about him as chief of staff was, while many would say that, yes, he was able to get a lot of shots out of the door, you have Dr. Fauci talking about the fact that he was this great management mind in order to take the Biden administration's COVID policy of really making sure that everyone across the nation had access and fair accessibility to shots. There was that stint that there was a lot of pushback from Republicans and Democrats, as well as European leaders, when they didn't open the borders into the U.S. And that was the summer of 2021. It took them to the fall to get up to the allowing more travelers that were vaccinated to come into the U.S.
Anne-Marie, let me cut to the chase. Mr. Zients is a Bainite, a Bainey, whatever you want to call it, out of Boston.
Yes.
And the bottom line is he's got more in common with Mitt Romney than anybody else in Washington. What Senator Warren's going to ask is, wait a minute, is this guy a Democrat of moderate or progressive ilk? And the answer is she's going to say Mr. Zients ought to pay a wealth tax. I mean, is this the guy the Democrats want as the gatekeeper to their Democratic Party president?
Tom, this is exactly what the discussion in Washington is. It's those centrist Democrats are excited to see someone like him take over this role and think he can do a very good job. And then you have those like in the Warren camp that he's just not progressive enough. He has too many ties to the business community. But what you've seen this administration do is 2 years, they really leaned into the progressive side of the party, and you started to see them walk a little bit of that back. Also, as the president is preparing for a potential 2024 run.
Quickly, what's your day calendar this week? What's the appointment, the moment, the party, whatever that matters to Anne-Marie Horton?
I think it has to be tomorrow. The president will be meeting congressional leaders, and that means Speaker McCarthy. And let's see what comes out of that meeting. The president maintains that he will not negotiate on the debt ceiling, and you had all the Republicans out on the Sunday shows saying that's the only way forward.
A complete success. We got through that, Lisa, without talking to Anne-Marie Horton and mentioning classified documents. Anne-Marie Horton, thank you so much from Mr. Zients. We'll do that next time.
Yeah, exactly.
From Washington as well. You know, it's the American way. It's an exhausting process. What I've kept score of personally is exhausted Treasury secretaries, and you see them right after their tenure, and they're just exhausted. Destroyed.
You can see all
destroyed.
of the,
90 days later, it's like, wait, is that the same guy?
Well, that's also
and
with
there's
presidents,
a lot of that.
right? I mean, basically they come in and then they age 40 years during their tenure. Yeah. There is this issue with the debt ceiling debate. We remember back in the day when we were talking about it and laughing and making fun of some people who indicated that some of the things that were happening in the Republican Party might indicate debt ceiling debates. I'm just saying.
Point taken.
But I think that, look, I think that the important thing here is the longer term credibility. Everyone's expecting that there will be some sort of resolution, but the longer they go to the deadline, the more there will be this flare up and this freak out. Does that actually have any longer term consequence, or is it basically just a wash?
To your point, I would suggest that 2011 has scarred all, including those that think this is a non-event, which we heard some of this weekend as well. Okay, I'm going to set this up, and then we're going to do this in the next half hour as well. Pharaoh is on assignment in London. That is correlated with a small soccer game. As you fly into Heathrow through the fog of the weekend and you look down, on the River Thames is a football field, soccer field out of the movies. Yeah. It's called Fulham. We'll talk to John Farrow about that with Jeremy Stretch in London. Stay with us from London, from New York. This is Bloomberg Surveillance. Good morning.
I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Bloomberg surveillance. Good morning on a Monday. Lisa Abramowitz in New York, back from Davos. Mr. Farrow in London. We'll go to him here in a moment. I'm Tom Keene. Thank you for joining us on a really interesting week. Before Central Bank Derby, there's an auction derby out there as well, as Lisa mentioned earlier. But I want to take 30 seconds here, or maybe even a little longer. It's deserved. I would think for people that ignore crypto, right now they ignore it at their peril. There's something... We had some conversations on this last week, Lisa, and there's something percolating below even as Bitcoin comes up.
Well, you mean in terms of the genesis and the bankruptcies and the issues that people have where it's a washout. What I thought was interesting is behind the scenes, people who are into stable coins or some of the other instruments that are a little bit more established and want regulation are kind of hoping for the failure of some of these other companies because they want to just get the washout done so they can move on.
That's the optimist view.
Well, and the optimist's view views crypto less as sort of a speculative tool and more as an instrument to disintermediate the Western unions and the banks for
the heart of the zeitgeist over the weekend. I put this out on Twitter. And I have the clearest memory of sitting with John, and we're watching World Cup, and I'm looking at one of these crypto people promising 8 or 9 or 10% on the web. And the heart of the matter, as I mentioned, this whole thing is structured on what we used to call yield hog. It was real simple. Margie Patel would know this, who we talked to earlier. You can make 7% instead of 4%. Isn't that the whole shtick?
Well, and actually there were a number of stories of people who put their life savings in some of these accounts because they thought they were high-yielding accounts. There was this one guy who put his mother's savings, and she keeps asking him, where is it? How's it doing? And he keeps lying to her because he doesn't have the heart to say he can't get it out of the exchange. It is painful stuff, especially where it raises this question, well, who's then telling them, you can't promise 8%, 9% yield if you don't have what's backing it. You have to put a disclaimer saying you might lose all your money or not be able to take it out.
Even more painful, crypto for Bloomberg on the terminal is under the currency key. Are we still under the illusion BitDog is a currency? I don't think so.
Well, there is this sort of interesting distinction between Bitcoin as a commodity-like speculative instrument and other aspects of the crypto universe as a currency. From a bigger standpoint, there is a question of how do you foster innovation and not cause it? No, I'm serious. In a period of restraint with higher rates and at a time of rampant fraud, when people who are bad actors could go into a world that was really pumped up by low rates and do what they want.
Well, they're going to have to restrain me, get out the surveillance cork. Dollar stronger today, DXY with a 101 level, just barely. Yen 130.22. Japan's sort of quiet here over the weekend. I'd look at Euro sporting as well. Rounded up 1.09. And John Farrow living large with a 124 rounded up on sterling. Farrow looking at, I think, 4,000 square feet over that little cutesy pie metal bridge
square feet
across the River Thames as well.
Short Austria.
Let's go there. We'll save the soccer chat for later. I mean, John, currency dynamics is led in London by the recovery from 103 to 124.
Two things here, Tom. Number one, I'm funded in US dollars, so I'd rather take 103.50 than 120 plus. Let's clear that up. The second thing, I've got a guess with me. Do you have to do that to me? Fulham. Repeat after me.
Okay,
Fulham. Not
Westham.
Nailed it.
Fulham.
Okay, 2 minutes.
Warwick.
Fulham.
Got it.
Fulham. You're killing me. Euro dollar right now, 108.83, very close to 109. We took out that level a little bit earlier this morning. I'm happy to say here in London I can catch up with Jeremy Stretch, the head of G10 FX strategy at CIBC. Jeremy, great to catch up with you, buddy. Good to see you. Front page of the FT this morning for all to see. Europe can avoid recession. The Eurozone can avoid recession. Can the Eurozone avoid recession?
Well, certainly the mood music has materially changed because of the retreat that we've seen in European gas prices. And of course, we've also seen that Chinese reopening narrative, which is providing a slightly more constructive backdrop for the German export sector. So the combination of those two factors does suggest that Europe might, and Germany at the leadership of that, might just avoid that negative GDP print. And that's obviously one of the catalysts which has really been driving this euro recovery narrative, alongside the presumption that the ECB is seemingly much more hawkish than the Fed.
It's a relative story, isn't it? Stagnation versus recession. Now we need to talk about stagnation versus expansion and recovery. It's a big difference between the former and the latter.
No, indeed there is. So in a sense, I think what we had is that obviously going through the third quarter last year, we had an enormous degree of negativity priced in or baked into the sort of the Eurozone recovery narrative, because of course we were talking about the potential for gas rationing. Now here we are at this stage in the winter period. Now it is remarkably cold here in London, as we know at the moment, but the actual winter itself has been relatively mild thus far. And if you look at European gas storage levels, they're running around 20% above the sort of levels you would have expected normally at this time of the winter. So that eases the burden in terms of the refilling of those gas storage tanks through the course of this summer. And of course, we've seen Germany opening its liquefied natural gas ports in terms of Wilhelmshaven, for example. So the ability for Germany to get those LNG capabilities or flows from the US in particular has helped to alleviate some of those recession risks.
Firing up coal as well over in Germany.
Well,
to do the same
which
here in
is
the UK.
which is an interesting one. So in a sense, that's one of the legacy issues. So that's why it was fascinating to see, the Greta Thunberg narrative being put alongside at the World Economic Forum in Davos.
You mentioned the ECB. Here's a question for you. 2023. Does the ECB hike more than the Fed this year?
Yes, I think it does. I think we're very much in this steady and significant policy narrative. To sort of paraphrase Madame Lagarde and throw Margaret Thatcher into it, the lady's not for turning in terms of the interest rate story from the narrative that we saw from last week. So it seems likely to go along with the comments from Klaas not over the weekend that we're going to see at least 250 basis point moves from the ECB the next two meetings. Do they go beyond that in terms of into the spring? Possibly yes. So that, I think, does suggest that the ECB is going to be a little bit more hawkish than the Fed, because if the market is right, and obviously markets are tending to be very aggressive in terms of calling for a moderation in terms of policy tightening from the Fed, then that does suggest the ECB is going to be more hawkish.
Producer SocGen this morning, writing in London, for SocGen, saying a spoonful of optimism helps the dollar go down. You want to play that against the yen, against the euro? How do you want to play that story?
Well, I think the yen is an obvious and an interesting one, because again we've seen a degree of policy uncertainty really writ large after that adjustment in terms of yield curve control back in December. Now those minutes from that meeting that have been released overnight suggest that a lot of the BOJ members were worried about the communication aspects of that change. But I think it was always going to be the case that to expect a degree of policy normalization from the BOJ this year, but more so after Kuroda leaves office, because of course he's only got one more meeting to go. So I think there is still some substantive scope for yen appreciation. So we'd be looking for runs up to maybe 131, 132 in the nearer term to provide better levels to start short, looking for a return back to 120.
The words we use matter. You said normalization and Japan in the same sentence. So we've had several decades now of zero rates in Japan. What's normal for Japan?
That's true. I mean, I've been in the market for some considerable time, and Japan and Japanese monetary policy has been generally the same. They've been always aiming for this 2% inflation target, which invariably they've missed, other than in sporadic and exceptional circumstances, as we're seeing now. Normalization, though, I think is a process of moving away from that negative interest rate policy. So I think that's going to be the dynamic that we're going to see. So if we start to see Japan moving away from those negative rates, that has enormous implications for fund flows, because, of course, Japan being that major exporter of capital, exporter of credit in terms of looking for those higher yields, if there is a degree of dislocation in terms of those fund flows and that exiting from Japan, then I think that has enormous implications. So as we look for Treasury JGB spreads to continue to compress, that